पहले आप स्टार्ट करके मैम को देना।
Okay. So, good evening, friends. Welcome to each one of you in this conference on international taxation. And as a Team CASA founder, I welcome to each one of you. Our both the eminent expert, CA Geetika Gupta ji, welcome to you, ma'am, for this first and opening session. And thereafter, second speaker and rather I should say our team member Sachin Sinha ji, welcome to you.
Thank you, sir.
Platform on the as a second speaker. Friends, as we all know that we have shared the schedule for all 3 days, what we are going to learn in next 3 days. Definitely, it is going a good learning in which we are going to cover basics of international taxation and residential status in this first session. Thereafter, tomorrow, we will have a detailed study, practical case study on 15 CACB foreign remittance. And day 3, we will learn basics of transfer pricing, practical case study, so that we can use these learning in our practice as well. Before inviting today first speaker, I would like to brief about her. Geetika ji is a chartered accountant by profession. She has over 18 years of experience in handling of direct tax matters. Her experience includes advising large Indian and multinational corporate houses on variety of tax matters, including international tax matters, due tax due diligence, inbound and outbound investment matters. She has been associated with the Big Four for a long period of time. She is regular speaker of international tax conferences, seminar at the various study circle, chapter and NIRC ICA forum. Now, I would like to brief about our second speaker, Sachin Sinha ji. Sachin ji is a fellow member of ICI having 20 years of experience. He is founder partner of Prakash Sachin and Company, Chartered Accountant. He has in hand experience of taxation, management consultancy. He has developed himself in advisory, litigation, and handling other commercial issues. He has completed a certificate course on of ICI on the international taxation, transfer pricing, audit and assurance on NPO, concurrent audit, forensic audit. Rather, I should say he has covered many courses from the ICI, completed the course of IFA, International Fiscal Association, Delhi chapter. Apart from this, he is a special invitee with the various study groups of International Tax Committee of NIRC for the year 21-22 and this year also 22-23. He is co-opted member of ICA CPE Committee, executive member of IFA India branch, member of Research Committee of International Taxation of NIRC. He has authored also a tax audit book, Basics of PE, handbook on issue on 15 CACB. So in brief, I would like to say that Sachin ji is also having a good knowledge on this income tax, international taxation. So today's session is going to be a wonderful session. So Sachin ji, I invite Geetika ji for the elevation.
Yes, please.
Okay, so straight away, I request Geetika ma'am to take up the first technical session, and definitely we will have a great learning on this session. Over to you, ma'am.
Thank you so much, Ji, for such warm introduction, and pleasure hearing from you and a lot about Sachin. I am happy to have him, as my co-trainer. So I'll start with
Yes, ma'am.
this. Good evening, friends.
There's some problem, I think, no? Technical issue.
Yes, sir. In the meantime, Madam is connecting. One announcement that we will share the recording and presentation to each one of you over the mail. And you can post your query in the chat box so that it can be a wonderful discussion. Anantaji, just she is going to fix up. And once again, good evening, namaskar to everyone.
So these are the basically drawback of webinar.
Right. Some benefits and some drawbacks are always there in the system.
And sometimes it is beyond your control. So once
Right.
you start and then connectivity is not there. Yes, now she is back.
Yes.
Ma'am, unmute yourself, please. Unmute yourself. सुमित भाई आप कीजिए प्लीज इनको.
नहीं, she can do. Just a minute. Okay.
Yeah, sorry. I just got disconnected. Apologies.
No problem.
Okay, so before we discuss about the basics of international taxation, it would be, just be relevant in a minute to talk about the origin of the India taxation. India taxation goes back to the ancient times. We come across the word kar in Srimad Bhagavatam and Bhagaduga in the Vedas, which means the tax collector. So the first specific mention of tax in the written history of India is in the Arth Shastra, which mentions both direct and indirect taxes. In modern India, for the first time, Income Tax Act was introduced in 1860, and then paradigm shift in the records of taxation happened when, based on experiences and reports of various committees, Income Tax Act 1922 was introduced. Income Tax 1922 was used to frame the Income Tax Act 1961. With this, we will move to the international tax. May I request Sachin to display the presentation? Thanks. Next slide, please. Yeah. So friends, before talking and deep diving into the concept of international taxation, it would be good to understand what is the need for international taxation. In recent times, the area of international taxation has gained importance. Globalization has resulted in many-fold increase in the volume of international transactions. So it's not only about the quantum increase of the international transactions, but it's the very nature of the international transactions which has become very, very complex. So consequently, the tax implications of the international transactions assume great significance. While the globe converges into one big marketplace for purchase and sale of a variety of goods and services, each jurisdiction fightens to tighten its rope to share its grab of taxes, that is, assertion of taxation by every country. That is, that is the reason it comes about what is the importance of international taxation. And we all know that when double taxation occurs, it hampers the cross-border activities, investments, and transactions. Globalization, though, has brought many benefits to the world, but people and world has realized that globalization has facilitated tax evasion and avoidance, resulting in a strong sense of unfairness. Loopholes in the international taxation allowed multinationals to artificially yet legally to low tax or no tax jurisdictions. At this stage, it will also be relevant just to mention about BEPS and MLI. So G20 and OECD countries, they work together to build robust international standards, working upon, the measures to handle BEPS action plans, the treaty abuse, etc. With this, the MLI was introduced in order to take into account, to give effect the various action plan measures. May I request next slide, please, Sachin? Yeah. So as we talked about double taxation, it is important to understand what is the meaning of double taxation and what are the types of double taxation. Double taxation normally refers to when the same income is getting taxed twice. So there are two types of double taxation, first being the juridical double taxation and the second being economic double taxation. I'll first discuss the concept of juridical double taxation. It is basically taxation of income of a single legal entity in more than one jurisdiction. So I'll explain this. It's taxation of the same income in the hands of same person for the same period due to overlap of taxing jurisdiction. Let me explain this by way of an example. Let's say A is an individual who earns royalty income in country X and A is a resident of country Y. Now A's income will be taxed in both the jurisdictions, that is the country of residence, which is country Y, as well as the source country, which is country X. So this is resulting in juridical double taxation, that is taxing the same income in the hands of the same persons in two jurisdictions. Now talking about economic double taxation. This is a concept when the taxation of the same income happens in hands of more than one legal entity. So taxation of same income in the hands of two persons for the same period. Let's understand this by way of an example. So company A faces transfer pricing adjustment in country X. Let's understand this by way of an example. An Indian company, it faces a transfer pricing adjustment by the transfer pricing officer in India. Now this Indian company's group entity is also taxed on the same income in the overseas jurisdiction. Now same income is taxed twice in two jurisdictions, resulting in the concept of double taxation. Next slide, please. Let me explain this by way of an, I think there is a raise of hand.
Ma'am, can we take queries later on so that we can discuss?
Sure,
Secondly?
sure.
Yeah, sure, sir, sure.
Avneet, we will take up the query later on. Yes, sure.
Okay. So now taking the other example of the juridical double taxation. Yeah, just a second. It's just my screen. I'll take a second. So let's say there is an Indian company which is a resident of India. It has set up a branch in UK. So India is the country of residence and UK is the country of source. So UK will tax the profits earned by the UK branch because that's a source country. Now India, being a country of residence, will tax the entire income of the ICO on a worldwide basis, including the profits of UK branch. So this is an example of juridical double taxation happening. and the tax relief can be claimed by ICO in respect of taxes paid in UK under the Indo-UK DTA. Next slide. Another example of economic double taxation. When one state attributes an income or capital to its legal owner, whereas the other state attributes it in the hands of the economic owner, it leads to double taxation. Let's understand this by way of an example how. Country X levies dividend distribution tax on the company resident in that state. So let's say there is an company ABC Limited which is subjected to dividend distribution tax in the resident state. Now country Y, it levies the tax on the dividend received by the shareholder who is resident of country Y, but receiving the dividend income from shares in ABC Limited. So what is happening here is ABC Limited, resident of India, let's say, paying the dividend distribution tax, and let's say the shareholder of this ABC company, it is a resident of country Y, let's say US. When it is receiving the dividends in US, it is also getting taxed in the other country because of its domestic tax laws. So this is a case of economic double taxation. Next slide, please. So friends, here it is very important to understand, while we have talked about the types of double taxation, what are the circumstances that are giving rise to double taxation? That's basically what we normally talk about as the source and the residence link. The taxability of a company, in fact, of a foreign entity in any country, depends on two distinct factors. That is, whether the company is doing business in the country or with that country. So these words, these concepts are very important. Doing business with a country or in a country. So there are two types of connecting factors, residence and source. It means a company can be taxed in a country either on the residence link or on the source link with a company. So if a company is doing business with a source country, with a host country, host or source could be used interchangeably, then besides being taxed in the country of residence, which is the home country, it will also be taxed in the host country on the basis of the source link, because the company is heavily engaged in doing the business in the territory of this other country. For example, company doing business through the branch in another country. Now, if a company is doing business in a source country, it is getting taxed like this on the basis of the source link. However, if a company is doing business with another country, in contradistinction to in, I'm using the word with, the business is being done in another country, it would generally be subject to tax in its home country alone based on the residence link, since the company is not actively engaged in the carrying on of the business with the source country. However, it is relevant to note the SEP, significant economic presence rules, wherein even in another country, the tax liability may occur. Example is, as per the Income Tax Act, transaction in respect of any goods, services, or property carried out by a non-resident with any person in India, including provision of download of data or software, may get taxed in India under the domestic tax laws, provided the transactions during the year exceeds the threshold limit. So the concept of the source and the residence prevailing in the majority of the countries is the root cause of double taxation. And in order to overcome this impact of double taxation, the countries enter into bilateral treaties, which is also known as double taxation avoidance agreements, which is basically to allocate the taxing rights so that the income may be taxed only in one country and exempt in the other country. There may be cases when the income is taxed in both the countries. In such cases, the treaty provides for allowing credit of taxes in the country of the residence. I'll take a pause here because this concept is very important, so that if there are any questions relating to at least the source or the residence conflict, we can take.
Avniji, you are allowed to ask your question.
Good evening, everyone.
Ji.
Geetika ma'am, I just need to confirm. It was earlier said that economic double taxation, where branch is being taxed by one jurisdiction and parent company is taxed by other jurisdiction. It will be constituted as a different persons.
Yeah, yes, see, it is basically an example of the juridical double taxation, wherein it is getting taxed in the hands of the same person, because branch is the same entity, but by two jurisdictions.
And
the branch is so separate from the company itself.
All right. And then what could be the best example for EDT, economic double taxation?
See, economic double taxation, there could be two examples what I discussed. One is the transfer pricing adjustment. So let's say there is an Indian company. It is getting additions on account of transfer pricing adjustment in India. Let's say it has paid certain headquarter charges to its parent company. The transfer pricing officer says, no, the arm's length price is zero for that entity. This is not allowed. And the same income, one in the hands of the Indian company is disallowed, same income in the hands of the other legal person, that is the foreign entity, A company making a payment to B overseas company. So same income is taxed in the hands of the B overseas company also. So this is a case of economic double taxation, wherein the same income is getting taxed in the hands of two people.
All right, ma'am. Thank you.
Thanks. Okay. So till here, now we have
in the chat box. Any example of source conflict?
Yeah. See, source conflict rule is, let's take an example, a foreign entity rendering fee for technical rendering services to the ICO, Indian company. So Indian company, while making payment to the foreign company, will deduct the withholding taxes. The Indian company will say, because the source of income, the pair is the Indian company, the ICO will say the foreign company is subject to tax. So foreign company rendering services to an Indian company will be taxed in India on account of the source rule, wherein the Indian company will withhold the taxes. Now this foreign company will also be taxed in its country of residence. And now in the country of residence, by virtue of the tax treaty, it can claim exemption deduction of the withholding taxes which has been made by the Indian party while making payment to it.
So can I add something here?
Sure.
Okay. So just to explain the concept what you have given just now. So as you know that in India, we have both the concepts are available, like source-based taxation and residence-based taxation. So while talking from where this comes from, so where for this purpose we refer section 5, and section 5 talks about resident and non-resident. So let's refer to non-resident, because we are dealing with the transaction with the international, which have impact on international taxation. So let's refer section 5 subsection 2, which says there are two clauses, A, B, which says income received or deemed to be received in India by such person or by any other person on behalf of such person. And the second is income accrued or deemed to accrue in India in that year. So while talking about, as Geetika said, that the concept is assuming the income accrued arises outside India, but that is income accrued arises outside India, then the government of India wants to tax that income in India, then we can say that, of course, here you can tax it only by way of if the person is resident of India or if the income is accrued arise in India. So if the person is resident of India, then we say that it's a residence rule. Even though his income accrued arise outside India, anywhere in India, anywhere in the world, his income will be taxed in India. So this is a residence rule. And in case of source rule, income accrued arise outside India, but on the by virtue of section 9, it comes to tax for the in India, then this source rule and residence rule will apply. And then you can say that if taxed outside India, then can we get the credit in India, and then juridical double taxation applies. So this is a concept how it comes to up to this level. So this is from my side, ma'am.
Sure. Thanks, Sachin. Any other questions we have?
No, ma'am, we can continue. No.
Sure. Yeah. So we discussed in the last slide relating that when double taxation is there, hence there is a need for a tax treaty to overcome this double taxation, as double taxation hampers cross-border activities, investments, etc. Now, when we refer to tax treaty, the first two lines on the slide, which mentions what is a tax treaty, in simple words, it's an agreement between two nations, between two countries. I would like to mention here that the interpretation of DTAs, it requires a very different approach than the interpretation of the domestic tax laws, because domestic tax laws is based on interpretative principles set out by the national courts, whereas DTAs, they are an international agreement between government of two countries. So the treaties have to be interpreted in light of the customary principles set out under the Vienna Convention of the Law of Treaties. So what tax treaties are doing is, it is allocating the taxing rights between the two contracting states, that is the country of residence and the country of source, which we talked about. Again, it's very important to understand that treaties can relieve only tax burden. They do not create a charge. And this has also been mentioned by a renowned tax commentator, that a tax treaty neither generates a tax claim that does not otherwise exist under the domestic law, nor expands the scope. So, many times a question comes that in case domestic tax law is more favorable and the tax treaty is creating a charge, what do we do? Is it that the send income needs to be taxed? No. The principle is that in case the domestic tax law is more beneficial as compared to tax treaty, then the same shall prevail. So the tax treaties, they work on non-aggravation principle. In other words, if an income that is not taxable under the domestic tax law, such income cannot be taxed in accordance with the tax treaty provisions. So it is safe to conclude that no new charge can be created under the treaty. The purpose of the tax treaty is to allocate or distribute the taxing rights between the source state and the residence state. It cannot create a new charge which is not provided under the domestic tax law. Next slide. Again, continuing to what we discussed in the last slide, what is the treaty? What is the need of a treaty? What type of treaties are there, comprehensive or limited treaties? I would just like to throw some light. Vienna Convention, it defines treaty. But what is Vienna Convention? It's a multilateral treaty that's signed and ratified by several countries which codifies the customary international law for interpretation of treaties. So DTA comes into play to mitigate the hardship subjecting the same income to double taxation. So the first part we talk about, tax treaty is a distributive rule. This is what we talk, that it is distinct from a taxing statute. What we discussed in the earlier slide, that it's a different way to interpret a treaty. It has to be a plain meaning given to it as compared to the domestic tax law. And second, we discussed, it cannot tax an income which is otherwise not taxable. It cannot tax an income at a higher rate. The next is the type of treaties. That's DTA can either be a limited DTA or a comprehensive DTA. And along with the DTA, there are protocols. There is memorandum of understanding, exchange of information, forming part of the DTA, which enables interpretation of a DTA. The limited DTAs are those in which certain limited specified type of incomes are dealt. Let's say only income from international air transport in one of the treaties. Whereas comprehensive DTAs are those which covers almost all type of incomes covered by the model convention. Let it be talking about P, dividends, interest, royalty, FTS. It will talk about all nature of incomes and how the same needs to be taxed. There is another concept of tax information exchange treaties. So TIEA, this is an agreement between two jurisdictions to share information with each other on a bilateral basis. TIEA is not a double tax treaty between two states, but it is just an agreement between two jurisdictions for the purpose of exchange of information. And the purpose of TIEA is to promote international cooperation in the tax matters through exchange of information between two jurisdictions. Again, the objective of the treaty is to protect against double taxation, prevention of discrimination at international context, mutual exchange of information, legal and fiscal certainty. Next slide, please. This is again need for a tax treaty. We discussed this, allocating the taxing rights, elimination of double taxation, non-discrimination, resolution of the disputes, and assistance in collection of fair taxes. So on the allocation of the rights, would just like to mention here and correlate with the Indian Income Tax Act. As under the Income Tax Act, the income is classified under 5 heads: salary, house property, business income, capital gains, other sources, for determining the income chargeable to tax in India. Similarly, under the DTA, the income is characterized under Article 6 to 22 for the purpose of allocating the taxing rights between the country of source and the country of residence. Generally, the resident state has the primary right to tax the global income of its residents unless that is exempted under the domestic tax law, and the right of the source state gets curtailed under the DTA as it's a secondary state. Next slide, please. Yeah. With this, we will move on, to the certain concepts in interpretation of a tax treaty and the model conventions. We often hear the words OECD, Model Convention, UN Model Convention, US Model Convention. These are the commonly known. But what is a model convention? It's a blueprint of a tax treaty that serves as a guide to drafting and interpreting a tax treaty. So there are different models which have been developed over a period of time on which the tax treaties are drafted and negotiated between the two nations. These models, they assist in maintaining uniformity in the format of the tax treaties. These models also serve as a checklist for ensuring exhaustiveness or provisions to the two negotiating countries. So OECD, UN, US are the most common ones. See, these are only model conventions. When it is actually a tax treaty between the two nations, that treaty is negotiated between the two countries, and then a treaty is formed. So OECD's UN US model, they are schools of thought. So talking first about the OECD, it was framed by the members from the developed countries, and it gives importance to the residence-based taxation. In contradistinction to OECD, the UN model, it focuses on the source-based taxation, and it represents a compromise between the developing and the developed nations. Now again, to these model conventions, there are also commentaries available which helps in interpreting of the treaty provisions. There is a commentary to OECD, UN, US model convention. It represents the views of the different members of the OECD or UN. Next slide, please. This is again on the principles of the interpretation of a tax treaty. That is, the text of the treaty is of primary importance. The scope or the applicability of the treaty cannot be enlarged by assigning meaning which is contrary to literal terms. The principles adopted in the interpretation of a treaty has to be simple, liberal, not against as we do in the domestic tax laws. And the treaty is to be interpreted in good faith in the light of its object and purpose. Departure from the plain meaning of the language of the treaty is permissible only to avoid the absurdities, and in such a manner that it makes it workable rather than redundant. The words employed in the treaty are to be given a general meaning, general to the lawyers and general to the layman alike. Again, the apex court in Azadi Bachao Andolan has held that there has to be a purposive liberal interpretation, and the principles to be adopted in interpreting treaties are not the same as employed in the statutory legislation. Friends, this is little theoretical, but in the first few slides, it is important to discuss these aspects, because when we come to practical issues, when we will be moving to the next slides about the MFN clauses, the controversy in the MFN clauses, how the courts are interpreting, then comes the importance that how the treaty needs to be interpreted basis liberal interpretation. That is why we are discussing here what are the principles and how the treaty needs to be interpreted. Next slide, please. Again, for the interpretation of the treaty, there are protocols. There is a technical explanation. There is a commentary, OECD, UN Model Tax Commentary. There are analogous provisions in parallel treaties, memorandum of understanding, court rulings, various author rulings. All these things are very important in interpretation of a tax treaty. Again, how we will link it, is, see, practically when we interpret a tax treaty, let's say we have to examine a clause of a PE. When we will be discussing in the ensuing slides, we will be talking about it. Like in case of agency P, sometimes the treaty talks about the dependent agent constitutes a P if it secures orders. Now, let's say securing orders is not defined in a particular treaty. Then how do you interpret? Then we take the help of the parallel treaties, that is analogous provision in the parallel treaties. Let's say in another treaty, the same language is used, and it may be interpreted, in one of the treaties, or there may be an explanation. So help can be taken from those treaties to interpret the language in the other treaty. Next slide, please. Yeah, I think after this slide, we will move to this structure of the tax treaties and more on the practical issues. So how to apply a tax treaty? It is see whether the issue is covered within the scope of the convention. Check that the treaty applies to the tax in issue. Treaty is in operation for the taxable period. Apply the relevant definitions. Determine which of the substantive provisions apply. That is dividends, articles, interest, capital gains, immovable property, which provisions apply. Check the provisions of the domestic tax law. see whether the domestic tax law is beneficial or treaty is beneficial. Whichever provision is beneficial will be applicable, and then apply the provisions of the elimination of double taxation. Next slide, please. Now I will just relate to the Indian tax law on treaties. Section 90 of the tax law says that where there is a treaty with a company, with a country, so section 92 applies, and it says that taxpayer has the option either to be taxed as per the treaty or the domestic tax law, which is more beneficial. And there can be cases in which the domestic tax law can be more beneficial as compared to the treaty. And section 91 provides relief for the double taxation where there is no tax treaty. Then there is a very important concept of tax residency certificate, which is mentioned in section 90. Next slide. Yeah. So see, now here comes a very practical application when we, see withholding taxes, or for a non-resident company, the applicability of TRC. So TRC is a tax residency certificate. Friends, it's very important to note here that this is a must and a minimum document to avail the treaty benefit. So it's not that if you have a TRC, you will be eligible for all the treaty benefits. There are a lot of other parameters to satisfy in today's time with the BEPS coming in like PPT test, etc. But TRC is a very important document. So tax residency certificate is to be obtained from the country of residence. I'll give you an example. Let's say a foreign company is providing certain services to the Indian company. Now, Indian company has to make payment to the foreign company. Now, let's say under the domestic tax law, it falls within the ambit of fee for technical services, which is a very wide definition. Now, under the treaty, this is not taxable because of the beneficial language of the treaty. Let's say it doesn't make available the technical services, so it is not taxable. So the important thing is that the non-resident needs to obtain a tax residency certificate from its revenue authorities. Practically, we have seen that like Indian financial year runs from April to March, whereas let's take an example, the overseas, the US, let's say, financial year will run on a calendar year basis. Then to cover the India financial year, TRC for 2 calendar year needs to be taken, which will cover the period from April to March. Now, again, in case all these specified things which are mentioned in the various bullets to Form 10F below, in case all these things are not appearing in the TRC, then the non-resident is also required to execute a Form 10F. Form 10F is a simple form which basically provides, there is a given format which provides the following details: that what is the status of the assessee, individual company, what is the PAN number, nationality or the country of incorporation in case of other than individual companies, what is the tax identification number in the country of residence, period for which the residential status is there, and address. Practically, again, we see normally the TRC does not mention about the PAN number. Therefore, it's advisable that do check whether in the TRC of the non-resident PAN is appearing. If not, Form 10F is to be obtained. Till now, Form 10F was obtained in a physical form. It was signed in a physical manner. Recently, there has been a notification that Form 10F is to be furnished electronically. Again, there has been a notification which has relaxed this condition in case of specified case of non-residents which are not having a PAN and not required to have a PAN as per IT provisions, that manual filing is allowed till 31st March 23. I'll take a pause here. I see certain questions in the chat box. the first question is, if TRC obtained, then 10F is also mandatory. The answer is, see, if all the details, as mentioned in the slide, that they are not appearing. Sachin, if you can move to the earlier slide, please.
Sorry.
Yeah. Yeah. So if all the details are not appearing in the TRC, which is status, PAN, nationality, tax identification number, period for residential status, address, then Form 10F needs to be obtained. If all these things are appearing, then it is not mandatory to obtain 10F. But basis practical experience, we have seen that PAN number, which is the unique identification number, which the Indian revenue authorities give to the non-resident. So normally we have not seen PAN number appearing in the TRC of the non-resident. Therefore, from a practical perspective, we advise clients that in addition to the TRC, do get executed Form 10F also, because these are very, very basic documents to obtain a treaty benefit. See, what happens from a practical perspective is the transaction is occurring in year 1. Now, this transaction will be subjected to scrutiny or audit, let's say in year 2 or year 3. So during the course of the audit proceedings, it's important to place this TRC before the tax authorities in order to, substantiate that I am a tax resident of a particular company and claiming that treaty benefit. Hence, we suggest that within the financial years itself, like it's April to March, obtain the TRC as well as get Form 10F executed. There's another question, where to submit Form 10F manually? So Form 10F is to be obtained, get it signed, maintain in the records. Whenever the case is there before the tax authority during audit proceedings, as you know, the first submission to the tax officer, wherein we say we are a tax resident and we are relying on the beneficial provisions of the tax treaty, we place a copy of TRC with the tax authorities. Next question is PAN mandatory for applying TRC by a foreign entity? See, TRC, again, see, if you are obtaining a TRC, that means the company is having some transaction with an Indian company. So either it will be filing a return, getting its scrutiny. So normally you will have the PAN, but PAN, I don't think it's mandatory. What I even understand is when it became online issuing of Form 10F, certain companies were able to file, TRC even without the PAN of the authorized signatories. But again, there is a notification from the tax authorities, non-residents who are not having a PAN and who are not required to have a PAN. So they can manually file 10F. So which itself clarifies that PAN is not a mandatory requirement. So where PAN is mandatory for foreign entity? So Kavita, it depends on a lot of facts. See, if the non-resident is rendering, let's say certain, if it has supplied software, let me take an example to an Indian company. The Indian company has withheld the tax. Let's say the company doesn't have a PAN, the Indian company withholds the tax. But the foreign company wishes to claim that as a refund from the tax authorities, because foreign company believes software is not taxable, then foreign company will necessarily have to have a PAN number. I think these are the questions in the chat box, no more. So with this, I'll hand over to Sachin to take the next slides.
Thank you so much, ma'am. And thank you for setting the tone. So with your example, I'd like to carry forward from here the example you have given that the Indian entity, the foreign entity providing foreign technical fees for technical services getting from India, and the Indian entity whether is liable to deduct tax or not. So let's start questioning whether the transaction is liable to deduct tax or not. Because what I understand as a practitioner, that we get a question from the client that we are entering into such type of transaction and whether the TDS is required to be deducted or not. So for the purpose of TDS, why starting from the little background, that then we would be able to understand what is the concept behind this. So let's read section 195 first of all. Section 195 says any person responsible for making payment to a non-resident. So assuming Indian entity is making payment to a foreign company, and that is for the purpose of any sum which is chargeable to tax in India. So assuming the sum is chargeable to tax in India, so how to test whether it is chargeable to tax or not. So as we discussed, section 9 is the basic section from where we test whether it is chargeable to tax or not. So let's go to section 9 and then refer, assuming fees for technical services 917. Then it says, yes, it is falling under the category of fees for technical services and the sum is chargeable to tax. If it is chargeable to tax, then we go to test whether any exemption or deduction is available to the entity. If not, what is the tax rate? Determine the tax rate as per the domestic law, and then go to see whether the DTAA is available or not, to go to 90, then 90 under bracket 2 says whichever is the beneficial provisions. So assuming that DTA is more beneficial by saying, as Geetika said, that in other country, in the treaty, the make available clause is there. However, in the domestic law, such clause is not there. So as per the domestic law, it is taxable. But when we refer to DTAA, it is not taxable. So this is one example, and there may be so many situations where you can get into such type of transaction where one way it is taxable in the domestic law, but anyway, on the other hand, it is not taxable as per the DTA provision, or other way around. So other way around is not possible because the whichever is beneficial. So you will, once it is not taxable in the domestic law, you will not go to DTAA. Or it may so happen that the tax rate given in the domestic law is, let's say, 10%, but in the treaty it is 5%. So of course you will apply the whichever is beneficial. Or it may so happen that in one country, the tax rate, the tax for the tax particular transaction, let's say capital gain, is not taxable, or in some other country the dividend is given exemption. So this is basically when the treaty is entered, the negotiation is being done in such manner so that the economic condition, considering the economic investment and the other considerations, so that what kind of benefit one can get and one can give. So this is basically when we enter into the treaty, the transaction took a place in such a manner that you are bargaining with other party, that I'll give you this much, and what you will give, how much you will give against this. So this gives to lot of due to this arises lot of situation where, like the concepts which here it is mentioned, a treaty shopping. So let's discuss what is treaty shopping and then tax haven. So you might have heard tax haven, because most of the clients says, I want to open a company in tax haven. LOB clause, when you read the protocol, you'll understand what is LOB clause. Beneficial ownership, when you read section article, even when you read article 10, 11, 12, you'll read, of course, in most of the beneficial ownership clause is there, most favored nation, and non-discrimination. So moving ahead, so what is treaty shopping? So let me explain in simple manner. So when talking about shopping, it means you're trying to get something. You're trying to get something. Now, if assuming a company which is in UK, and this company wants to make investment in India, and as per the India-UK treaty, they know that there is a capital gain taxation when they sell this share, what they are investing in the foreign Indian entity, or when they'll get the dividend, that is also taxable. So I'm taking hypothetical example. So by this way, if they come to India, then of course the tax cost would be high. So they try to find out whether is there any treaty through which India has entered and given the relief, and similarly the UK has entered and get such type of relief. So assuming India has entered into treaty with Mauritius, and where it says that we'll give you the capital gain relief or the dividend relief, and assuming the similar clause is there where the UK get with UK get with Mauritius, that okay, this relief is also available. Then if the UK comes to India directly, then of course the tax cost would be there. But if it comes through Mauritius route or through Singapore route or through some other route, they may get some tax benefit by way of using the other treaty. So they try to get do this. So earlier, if you say in Indian law, there is no concept of tax treaty shopping, but in the last budget, in the last finance act, they inserted this term. And if you read section 91B, then it says that treaty shopping is not allowed when you are doing this for the purpose of double non-taxation. So the treaty purpose is to avoid the double taxation, but it cannot give you a situation where you can be a double non-taxation. So this is the concept. If you see in this example, we have tried to understand, explain the manner how it works. But what I have explained is the concept. Coming to next, so tax haven, as you know, there are many countries or many countries where the tax rate is low or nil tax rate is there. So as Geetika explained in the beginning slides, that you want to do the transaction through non-treaty, non-tax countries or low tax countries. So why this is so? Because if UK wants to invest in India and they know that the tax rate is more or less same, so and there is no other benefit available to them, so they don't want to invest in India. Similarly, if then where they want to invest, they will choose those countries where the tax rate is lower or nil. So assuming till now, Dubai is also a destination where the corporate tax was not there. So assuming your client wants to do some investment outside India, then they will definitely come to you and ask where to invest, assuming, and that too for the purpose of taking tax benefit. So you can guide them, okay, there are so many avenues where you can invest and get the return from there, and you can save your taxes. But after global rule and after pillar one, sorry, after pillar two, I don't think that such benefit would be available. So Geetika ma'am can add something on this.
No, I completely agree with what Sachin is saying, and with the coming in, of the concepts like BEPS introducing concepts like principal purpose test. See, gone are the days when just a treaty benefit would be available to say that I'm a tax resident by just producing a TRC. You'll have to cross that barrier of principal purpose test. I mean, why you have invested in a particular jurisdiction. Let's say earlier people used to invest through Mauritius in India because there was a very favorable tax clause of capital gains. The question comes, what is the objective? What is the principal purpose? Why are you investing through Mauritius? Let's say the ultimate investor is US company and it was just investing through Mauritius to take the benefits of the treaty. So the concept comes that US India is not a favorable tax treaty, but Mauritius India is a favorable tax treaty. Then are you trying to interpose an entity in between Mauritius doing treaty shopping or taking a benefit of a tax haven to take just the benefit of the treaty? So in the times of today, friends, it's you'll have to clear that litmus test of what is the principal purpose to invest in a jurisdiction before getting through the treaty benefit. With the BEPS and MLI, the way the digitalization of the economy is happening. I mean, the concept of the P and the way it is being treated is very tightened by the tax government. Thanks, Sachin.
Correct. So while talking about as Geetika said that MLI, of course, BEPS MLI is now there, and the principal purpose test is required. And there are other like India Mauritius Treaty or India Singapore Treaty, there are LOB clauses there through which this transaction earlier it was allowed, or I can say that people used to do the treaty shopping. Now they have put some check on this. And after the MLI, the basic SLOB clause, it says that the minimum standard says that the principal purpose test is required, and that too you have to satisfy that why you came through this, and what are there are some conditions that you need to meet. So as we discussed that limitation of benefits, of course, if you want to take the benefit of treaty, you need to satisfy certain conditions, and you can see the LOB clause in the protocol, not in the articles. And once you tried, as you can see in the slide, LOB clause limits the benefits, because as we mentioned that the LOB means the limitation of benefit. You are allowed to get some benefit, but you will be there is some limit, and that too you need to satisfy certain conditions. So generally, a LOB clause is a treaty is designated. The LOB, so LOB clause is basically intended to prevent the treaty shopping, as we discussed. So as you know that you can not, it cannot be said that you are allowed, but earlier such restrictions was not there. So people used to do this treaty shopping, and I think in Azadi Bachao Andolan also, that the Honorable Supreme Court has said that since you only because of tax or leakage of tax revenue, you cannot say that it is not allowed. But after this, there are so many amendments made, and in the last budget, they said we will put this clause in the statute itself that treaty shopping is not allowed, and similarly that they put some limitations in the treaty itself, like India Singapore treaty, India Mauritius treaty. Earlier the capital gain transaction was beneficial through that treaty. So now they said you need to satisfy certain conditions, and if you want, if you need to prove that yes, we are into that country for the purpose of business, and for this purpose there are certain conditions like the 50 lakhs turnover is there, their head counts is there. So you need to satisfy those conditions, unless the department will say no, you are just there in that country for the purpose of taking the treaty benefit and nothing else. So the SSC has to demonstrate why they have come through this country, and why they can be said that they are not for the purpose of tax benefit. Because if the department proves that you are here only, you taken this route only for the purpose of taking the tax benefit, then the GAR provision may also invoke in this case. So
Sachin, just adding an
yes,
example,
yes,
just adding an example to the LOP clause, as Sachin, very aptly explained that certain amount of expenditure to be incurred. So one of the examples is India-Singapore Treaty. This is a treaty where an MLI is applicable, so the PPT test will be applicable. In addition, there is also an LOP clause, as Sachin mentioned, that you need to satisfy that certain X amount of expenditure has been incurred by the Singapore entity. The basic objective is it's not a sham entity and not just trying to obtain the treaty benefits. Thank you.
Thank you. So beneficial ownership concept, because if you read the treaty, as I mentioned, a few articles like Article 10, 11, 12, generally speaking, so based on the OECD model convention, that is interest, royalty, FTS, and few other articles, where the beneficial owner concept is there. It means generally the income is taxable in one country. As if I refer the dividend article, so it says that it will be taxable in the country where the person is resident. It means not in the country in which it is the dividend is declared, but it will be taxable in that country also. So if the beneficial owner is there, then a particular percentage can be applied. So this you can see in almost 3-4 articles, and this is very important concept of who can be a beneficial owner. So as it is mentioned in the slide, the beneficial owner is he who is free to decide. It means who is taking the shot. Basically, assuming I am the person who is taking the shot, and I have incorporated a company in UK, and through that UK company, I made an investment in Singapore, and from Singapore, I made an investment in India. Then who is taking the decision? So I am the person who is taking the decision. So ultimate ownership. So ultimate ownership is the key word. So as you know, in the Companies Act also nowadays, they ask for who is the beneficial, who is the ultimate beneficial owner. So UBO clause is there. As per, I think, section 79 or 179, it's asked that who is the ultimate beneficial owner, that you need to mention. It means not the company above that company who is holding that company, the company who is ultimately holding. So who is taking the shot? So whether or not the capital or other assets should be used or made available. So the concept of beneficial owner determines whether a person qualifies for tax residency treaty benefit. So assuming, as we discussed, that that UK company wants to invest in India, but they came through Mauritius route, and in Mauritius they incorporated a company. and the UK company is holding all the shares. So of course, if you see the Indian balance sheet, then it will be clear that UK, that Mauritius company is holding the share. So who is the owner? It means the Mauritius company is the owner, but who is the beneficial owner? Ultimately, who is going to be benefited? So that is UK company. Then then the act will say that will remove this India Mauritius treaty and will apply India UK treaty directly. Yes, ma'am. So now up to you. So most favored nation, if you can see this example. So most favored nation is basically what the treaty wants to say, that assuming India entered into in agreement with let's say Mauritius, for example, and it says that okay, I'll give you a MFN clause, and it means that if India enter into any any agreement with other country and give some benefit to that country, which is more beneficial with India and Mauritius, which India entered earlier, then it can be said that the India-Mauritius treaty shall be read to up to that particular in context. It will be read for that purpose for India and the new company, a new entity where the India has entered into. So it means for that India-Mauritius treaty has a particular transaction, particular treaty where it says that we will give you, let's say, tax at the rate of 10%. Subsequently, in the MFN clause is there, and subsequently India entered with, let's say, Germany, and it says that okay, we will tax you at the rate of 5%. Then India has to give that India-Mauritius treaty will be read for the purpose of that transaction 5%. So you can see in this example. So country A, country B, and country C, DTA between A and B provides the MFN clause. So this is the India A and B, sorry, country A and B, that is the original treaty where it is already there. And here in DTA between B and C. So due to MFN clause, residents of country A will be eligible for similar right as accorded to the country C. So if any benefit they will give to country C, it will automatically come to country A also. So terms of this treaty carry more beneficial tax treatment to the country. Yes, Geetika, you want to add something?
Yeah, just as Sachin explained, taking a very recent example and the controversy which is going on pertaining to MFN clause on the dividends. As we see in the various treaties like France, Netherlands, etc., which provides that the treaty rate is 10%, but then it provides an MFN clause. That is, in case treaty is entered by India with another country at a rate more restricted or a scope more restricted, then that beneficial provisions of the other treaty will apply to Netherlands also. So let's say the Netherlands rate was 10%, but the later treaty entered. Let's say Slovenia or Lithuania is 5%. So whether that 5% can be given to the India-Netherlands treaty also. So this is just a conceptual which Sachin and I am discussing here. Again, on this particular concept, on this MFN and on the dividends specifically, there is litigation again, how to interpret this, how the words are written, whether the country which signed the treaty, whether it was a OECD as on that date, etc. That's subject to litigation and the matter is subjudiced before the higher courts. So we'll leave that. But that's the basic concept of what the MFN clause is.
So I think, yes, ma'am. Now I can take pause here and hand over to you.
Sure. Thanks, Sachin. So now we will be talking about different articles. Some of the articles I'll be taking, some Sachin will be taking, like PE, Article 1, scope of convention, residency, capital gains, etc. So prior to that, just laying the context and setting a tone that what tax treaty typically looks like. So articles, so how we read treaty is there are different articles in a tax treaty which are numbered like article 1, 2, 3, etc. So sorry, Rohit and Kavita, I'll come to your questions. I'll just complete these 2 slides and we'll answer the questions then. So the articles of a tax treaty is divided mainly into 6 groups. It says the scope provisions, the definition provisions, the substantive provisions, provisions for elimination of double taxation, anti-avoidance, and miscellaneous provisions. So maybe Sachin, we can go to the next slide and explain this by way of a diagram, which may be more easy. Yeah. So you'll see, this we have tried to explain by way of some shapes. So Article 1, Article 2, Article 29 and 30 generally of a tax treaty that is pertaining to personal scope, taxes covered, entry into force and termination are the scope provisions. Then there are specific definition provisions which will fall under Article 3, which is general definitions, Article 4, which is residence provisions, Article 5, PE provisions. Then there are substantive provisions which are dealing in length about the various types of income, like Article 6 about immovable property, 7 on business profits, Article 8 shipping, 10 dividends, 11th is interest, so on and so forth, royalties, capital gains, independent personal service, dependent personal services, etc. Then there are certain anti-avoidance rules like Article 9, which talks about associated enterprises, and Article 26, which talks about exchange of information. And then there are provisions, articles about elimination of double taxation, Article 23 and 24. This is a basic structure of a tax treaty. So Sachin, before I hand over to you on the next slides, maybe we can take 1 or 2 questions on the topics we have discussed. So first is, MFN will be applicable for both the countries involved in the treaty or only the specific country? So Rohit, how it works is, like, let's say Netherlands is there. It says there is MFN clause in the treaty. It will say that any treaty which India has signed with another country, which is an OECD member country, and where the scope is restricted and where the rate is restricted, then the same lower rate will apply to Netherlands. So the text of the Netherlands treaty will talk about 10%, and let's say the text of the Slovenia treaty will talk about 5%. So in this case, we are talking about MFN clause to the Netherlands treaty, because then you will like to avail the beneficial rate, lower rate of 5% in the Netherlands treaty, because it is provided under the MFN clause, though the main dividends clause will talk about 10%. 2 more questions, one from Sunil Gupta, who's liable to submit Form 10F electronically, that is the non-resident entity, is liable to submit Form 10F, that is the same entity who was to obtain Form 10 TRC. The second question is, in case of software license import in India through foreign entity or any other transaction where TDS is required to be deducted by the Indian entity, is this mandatory for foreign company to obtain PAN, file Form 10F? Is there a need to file Form 15CB? Okay, multiple questions in one question. So just, let's say a foreign entity is supplying software to the Indian entity. Now, Indian entity can choose whether to withhold or not to withhold tax depending on the treaty, depending on the technical provisions. So giving this example of software, as now, more or less it is settled by way of the Supreme Court decision in case of engineering analysis, the Indian company may choose that, okay, it is not to withhold tax. The foreign company will have to give TRC to the Indian entity as well as 10F to, substantiate that I am a tax resident and don't deduct any TDS. And it's a separate matter. The Indian company may still may choose to withhold tax, which is their prerogative why it chooses so. But the non-resident will have to furnish its 10F. PAN or not, see, it's not a mandatory requirement. PAN is important. Let's say now the foreign company wishes to file the return of income in India and claim refund of the withholding taxes that has been withheld by the Indian entity while making payment to the foreign company, then it will be mandatory for the foreign company to obtain a PAN, because for filing the tax return in India, PAN is a mandatory requirement. And Form 15 CACB, it's more like the Indian entity making the payments will have to do the requisite compliances to remit the money outside India. Sachin, anything if you want to add in this?
So in this case, as you mentioned, that it is assuming it is not taxable as per the provision of 916, and considering the judgment of engineering analysis, and the Indian entity is making payment to the non-resident, considering it is not taxable, then in that case, a TRC is not required, because TRC is applicable when you are taking the benefit of DTAA. And if you are providing, if you are taking the benefit of DTAA, then of course the rate you are applying is the rate other than given in the domestic law. If assuming you are providing it as per the domestic law, the tax rate is the transaction is taxable for the time being, we consider that one transaction you are entering into and that is taxable, and you are deducting the tax at the rate of 10% considering the benefit of treaty, then in that case, of course, as Geetika mentioned, TRC would be applicable. And since TRC does not contain all the information, so in that case 10F would also be applicable. But in that case, because you have applied the tax rate at the lower rate, which is as per the treaty, then in that case, the return is to be filed by the foreign entity, because there is a tax gap. So they need to file, and then of course they must have PAN number. So section 105 says, 115 says that if the foreign entity, if the Indian entity has deducted the tax as per the full rate of applicable tax, then in that case, the foreign entity is not required to file the return as per the provision section 139. Otherwise, they need to file the return, and in that case, of course, the PAN number is required. Now, the other question is, if it is FTS or royalty, then you can say that why, since 206 AA is also there and it says that the PAN number is required, then there is exemption that in case of there are 5 categories, the dividend, royalty, FTS, capital gain, dividend, and interest. So out of in those cases, the rule 37 BC would apply, and in that case, TDS the 206 AA would not apply. It means the higher rate will not apply. So PAN number is basically for the purpose to give the credit to that entity, number one. Number two, to avoid the 206 AA. But it may so happen that 206 AA will not be applicable, even though if that entity has to file the return in India, then the PAN number will be applicable. So one more question from Mr. GD. In case of purchase of property, buyer is resident of India, whereas seller is non-resident, and the property is in India. Query is, most of the time NR asked to provide TAN of buyer. So it's a general, if you read section 9, it says in case of immovable property, it will be deemed to accrue or arise in India. In India means where the property is situated. So it's a law as per the domestic law, that where the property is situated, it will be taxed in that country only. So since in your case, the property is situated in India and the seller is a non-resident and the buyer is a resident. So when the buyer making the payment to the non-resident, then section 195 again comes into picture and says any person. So of course, even though is an individual not carrying any business, the turnover is less than 1 crore, immaterial. Any person responsible for making payment to a non-resident, not being a company or to a foreign company, any sum which is chargeable to tax. So here it is chargeable to tax. That's why the resident has to deduct tax, and that too under section 195. And in that case, the TAN number is required. So while dealing with the resident to resident, section 194 IV will apply, and in that case, TAN number is not required for the purpose of tax deduction. But in case of non-resident, the TAN number is required. That's why they're asking for TAN number. Kavita has asked one question, that means whenever TDS is deducted as per DT, then PAN is required to be obtained by the foreign entity. So if you refer section 115, it says, if the tax has been deducted as per the provision of DTAA, sorry, as per the provision of this act, or as per the finance, so rate given in the finance act, it means assuming the 10% rate as per the domestic law and as per the DTAA. So, and you want to take the benefit of DTAA, then in that case, the 10% would be applicable and no surcharge and no education sales will apply, because the rate which is given in the treaty is its absolute rate. But when you if you apply the domestic law, then the domestic rate, then it says the tax rate will be increased by the surcharge and education sales, as the case may be. So in that case, of course, the tax rate would be different. You are eligible to take the benefit because you have the valid TRC. Then you can take the benefit of a treaty. But in that case, of course, the government will say that you need to file the return here, and then you must have a PAN number.
So Kavita, just to add in your question, see, a non-resident is exempted from filing the return, as Sachin mentioned, under the provisions of section 115 of 115A of the Act, if the tax is deducted according to the domestic tax law. So the point is, you have to file a return where the tax is not deducted under the domestic tax law, where the tax is deducted under the treaty, which is a higher rate. That means for filing the return, PAN is a must requirement. So in case the tax is deducted under the Act, well and good. Then if you don't want to file the return for a specific exemption, then it's okay. But it may so happen non-resident may have different streams of revenue. So assuming there is only one stream of revenue, FTS, that is exempt under the Act, because the tax is deducted under the Act rates, which Sachin mentioned, tax 10% plus surcharge plus cess, then there is no requirement to file the return. No requirement to file the return means you don't have to obtain a PAN. But the moment you have to file a return, either because of the reason that tax is deducted under the treaty, or the second reason that you want to claim refund of that tax, because the payer may have withheld tax, but you don't believe as an assessee that the tax needs to be withheld. Supposing, the non-resident supply software and the Indian party deducts tax. The non-resident believes, no, this payment is not taxable. Then it will file a return, claim refund of that withholding tax.
So Amnit sir is asking, what is the crux of obtaining TRC and TDS on income to non-resident? Geetika, over to you.
Yeah, okay. See, TRC is a basic document you need to obtain for obtaining a treaty benefit. See, let's say under the domestic tax, I'll give an example. Provision of services is taxable under the Act. Now you say, no, I will apply the treaty, Indo-US treaty or Indo-UK treaty, which says that FTS is not taxable due to particular beneficial provisions available therein. Then you have to apply for TRC, which is a must document. Without that, you will not get benefit of the tax treaty. And a related question of Mr. Sunil Gupta is, if only TRC is obtained, what are the consequences? See, in the times of today, TRC is a minimum. It's a basic document. To avail the treaty benefit, you have to substantiate much more under BEPS. Have I satisfied the principal purpose test? I'll not go into details of principal purpose test. Otherwise, we'll spend next 1.5 hours on principal purpose test. But I'll mention it's a basic document to start for availing a treaty benefit, much more to comply for the PPT test. I hope both the questions stand answered.
Yes, I think yes. So now Mr. Ajit is asking, if we are making payment outside India for software purchase, TDS will be deducted. So Ajit sir, that needs to be tested as per the fact, but as Geetika ma'am has explained, that now this issue is more or less settled by virtue of the Supreme Court judgment at Center of Excellence, Engineering Analysis Center of Excellence. If the end user license agreement, because in most of the cases we are signing end user license agreement, then it can be said to purchase the software, and this is not a royalty per se, so it will not fall under section 916. So out of the question of royalty, and no tax will be deducted in that case. But you need to test. So this is not a blanket rule applies everywhere. You need to test as per the fact of the case, that whether in your case, whether all the conditions which is given by the Supreme Court will satisfy or not. Also, explanation 2 of 916 can be referred, whether you're falling under that category or not. Then only it can be said that yes or no, whether the tax is applicable or not. But primarily speaking, as per the law, if you are falling under the provisions which is given in the judgment, then yes, you are out of tedious responsibility. So Dilip sir has asked a long question.
Yeah, I'll take that. So the question is, an ICO is a holding of the entity registered in USA while transferring the profit by subsidiary entity from USA to holding in India has deducted TDS deposited with US government. Can Indian entity claim refund? This is a question. ICO is a holding subsidiary. US has withheld tax while making payment to ICO transaction. Why it has withheld the tax? See, supposing it's some a provision of a service by the Indian company to US, and US has withheld the tax, then yes, under the treaty, either the credit, I will not say refund, I'll say credit of that tax which has been deducted by the US government may be claimed, but it's important to see what are the facts, what is the nature of the underlying transaction on which the tax has been withheld, assuming that the same transaction is taxed in India being the country of residence, and also it is taxed in US being the country of source and taxes withheld, then yes, the tax treaty provides for tax credit mechanism to be taken. That is against the tax liability of the Indian company. The taxes which have been paid in US can be claimed as a credit. The judgment is engineering analysis. Vikas Agarwal. So should we move?
Yes, I think one question has been raised by Vipin.
Okay.
So whether TDS is also required to be deducted if payments are made by an employee through his credit card for making software purchase or renewal on monthly basis. So this is basically, if you're purchasing a software, then it will not directly fall under 916. Then you need to test whether the business connection would be there or not. If the business connection is there, then it can be said that to whom you are making payment, yes, the tax liability would be there in that case. So it is not important who is making the payment. Who is responsible for making the payment is important. The term used in section 195, any person is responsible for making payment. Assuming I am the person who is responsible, but I made the payment through Sumitji and said, you make the payment and I'll reimburse you, then it means I am responsible. Then the test criteria would be who is resident and who is non-resident. If that test criteria satisfied, then second test is whether the sum is chargeable to tax or not. If that test satisfies that yes, it is chargeable to tax, then only the TDS provision will apply. Otherwise, simply saying you are purchasing a software or you are making payment through credit card will not make any change. We'll need to test whether it is falling under the provisions of the law to make whether the sum is chargeable to tax or not. Making payment by way of credit card is just a mode of payment. Either you make by bank or credit card or by any other mode. So the important thing is responsible for making payment, and that too a non-resident. If this is so, then of course the 195 will apply. But the second test is whether the sum is chargeable to tax or not. So as far as your question, I think purchase of software will not fall under the category of 916. But business connection, it needs to be tested. Yes, ma'am.
So Kavita, on the next question, in interest of time, maybe I'll take this question towards the end. If the time doesn't permit, I promise we can discuss off the line.
Okay. So can we move ahead? Or you want to take questions?
So I think questions addressed, Sachin, maybe we can move ahead and then take the questions in the end. Otherwise, we may miss on a lot of slides we are left with.
Okay, so now come to the DTAA part. As the background has already been said, what is treaty, what, how it entered, and how it is to be seen. Now come to that what the treaty actually says. So I think this is we have covered from the OECD Model Convention. So Article 1 is basically gives you the scope of the applicability of that treaty. So when we refer to Article 1, because whenever you apply any treaty, you need to be tested whether you are falling under that treaty or not. So how it starts, person who is resident. So it says this applies to either or so resident of either or both of the countries. So it means this will apply only when the person on which you are trying to test is a resident of that country, or that person is resident of both the country. It means it may so happen that one person may be resident of two countries, then it can be applied in that scenario. So for let me give an example. Assuming a company which is incorporated in Mauritius, that is company which is resident in Mauritius because it is incorporated in that country, but by virtue of section 6(3), that is the place of effective management, that company becomes resident of India. It means that particular company becomes resident of both the countries. In that case also, that whether the treaty, which treaty will apply, then in that case we test the resident of either or both of the countries. It means if the person is not resident of that country, then the treaty will not apply. It means India Mauritius treaty, if you want to apply, that means the person must be resident of either India or Mauritius, then only India Mauritius treaty can be applied. If the person is resident of Singapore and having income in India and Mauritius, then the India Mauritius treaty will not apply. So whether the taxpayer is a person, so of course it applies to person who is resident of. So this is the term which is used in that article. So what is the meaning of person? What is the meaning of resident? So that is all explained earlier slides also. So whether the taxpayer is person, that is deal with the Article 3, and whether it is person who is resident is as per Article 4. So whether transaction is with a territory covered by the tax treaty, of course, Article 3 needs to be tested. Identical wordings, because this you will get in every treaty. And as per US Model Convention, of course, there is some difference. Irrespective of the residential status of a person as determined by Article 4, a contracting state would have the right to tax its citizen, or even in certain cases, former citizen who have given up the citizenship with the principal objective, the avoidance of tax. So I think in US law is in majority cases have some deviation, but for the purpose of understanding, we should presently focus on the OECD and UN Model Convention. Then I think the understanding would be clear. Then you can add plus and minus, and then you can see the effect of that transaction. And if you remember in the earlier slide, we read that the juridical double taxation and the economic double taxation. So the tax credit will be given only in the country in which you are a resident. So assuming I am resident of India and I have some income in Mauritius also, and Mauritius has deducted some tax there, I cannot claim my tax rate in that country. I need to claim tax rate in India, and that too by virtue of the treaty applicability of treaty. So taxes covered. This is also very important to understand it, which taxes are covered. So, ma'am, can I? In the earlier slide, can I, whether in Article 3, we will discuss that what kind of persons they are, like whether HUF or other person, which is as per the law in India, are not person in the other may not be person in another country. We'll discuss subsequently, right?
Yes, yes.
Okay. So Article 2, this is very important to understand the taxes covered, because assuming in India that the income tax, and on that the surcharge, and on that the education cess is there. So whether this is tax as per the treaty also, or this is tax as per the Indian law. So let's give me a simple example. Assuming a person who is resident of Singapore earned some income which is taxable also in India, let's say 10 lakh rupees only, and on that 1 lakh plus education cess plus surcharge, so 1,20,000 tax has been deducted on that. So whether he would be eligible to take credit in his home country only for 1 lakh or 1,20,000. So OECD model convention covers taxes on income and on capital. So that is the basic law, whether imposed. So Article 2 provides the taxes in respect of which benefit under the tax treaty would be granted. The tax treaty generally contain list of taxes as agreed between both countries. So earlier, if you remember, the wealth tax was there. So whether that will also cover or not, because in case of whether it will be apply for in case of not or any other taxes like equalization levy, in case of equalization levy, whether the treaty benefit would be available in case of equalization levy also. So that is also a very interesting part, that why this is out of the Income Tax Act and put into the Finance Act. And if you see the section 243 defines the taxes. So what is the meaning of tax? It says that it does not include interest and penalties. So now the question arises whether the education cess and the surcharge is also part of tax or not. So supplementary levies or surtax surcharge is generally covered. So it is generally covered, and I think recent judgment was also then to Sesa Goa. It says that this is all part of tax.
Geetika, you can unmute yourself.
Yes, yes,
You
now,
want to say
yes.
something?
Yes.
No,
You
no,
want to
no.
add something? Okay.
No, no, Sachin, good with me.
Okay. So now come to Article 3. Because this normally what happened in case of domestic law, there are a lot of definition, or for every term there is a definition in the domestic law, which is in section 2. In the treaty, that generally the definition we took from the domestic law, we refer for domestic law, but only when that is not defined in the treaty. So some or in few terms are defined in the treaty, but the question arises, what if the term, so it says defines general items, so concepts necessary for the understanding of DTAA, because few terms are very important, which is used in the treaty. So it is defined there, like inland waterways, that is defined under that act. So fiscal year, enterprises of contracting state. So why this is important? Because it may so happen that term is not defined in the domestic law. If any term which is defined in the domestic law and not defined in the treaty, so domestic law will prevail. If any term which is defined in the treaty and not defined in the domestic law, then the treaty will prevail. If any term which is defined in the treaty as well as defined in the domestic law, in that case the treaty will supersede. So if you see, there are few. This is a general definition. Apart from this, few definitions are given in the relevant article. Like if you talk about the scope of FTS or scope of royalty, the few items are added there. So whether it is not matching with the domestic law or not, that needs to be tested. But primarily this, as far as concerned to Article 3, this is a general definition, and this is very important. And this is unless the context otherwise requires. It means this needs to be read as per the context. So coming to residence. Why residency test is important? Because since beginning we are discussing, I am resident of India, or the company is resident of Singapore, or the person is resident of US. So what does it mean basically, and why this is important? Because if a person who is a resident of Singapore and having income in India, then of course India is a source country and the Singapore is the country of residence for that person. So in that case, who will give the credit? The first right of the source income, on the source income, the India will tax in as per the residency-based taxation. Singapore has the right to tax the global income of that, assuming that similar law is there in that country also. So in that case, it is important to test where is the residence of that person. So residency may be as per the domicile, So assuming in case of individual, first try to test for the individual. So if the person is, so if you see, in order to claim the treaty benefit, a person should be resident of one or two of the contracting. So as in the scope also, the treaty will apply only when the person is a resident of that or both of the countries, either or both of the countries. A person is resident of country if he is liable to tax in country by virtue of his domicile, residence, place of management, or any other category of similar nature. So this, if you remember, this term domicile, residency, inserted in section 6(1)(a) also. But for the purpose of understanding, any individual who is resident of both the countries, then the tiebreaker rule will apply. Otherwise, generally, we first of all we test as per the provisions of Income Tax Act. So whether he is resident of India or not, if he is resident of India, then we will apply all the provisions which is applicable for the resident. Assuming while you are testing, you find that that person is resident of both the countries, then you will enter into the tiebreaker rule. And what is tiebreaker rule? That needs to be tested because there, I think, watered down approach is there, and for that purpose. So yes, tiebreaker rule, residency in the country of permanent, so where the permanent home is there. So the first test is in case of individual, assuming an individual, I have income in Singapore and in India also, and I want to take and I'm filing the return. So while doing the basic test, applying section 6, that whether the person is a resident of India, I found that yes, the person is a resident of India. And the similar, assuming the similar law is there, and based on the law of that other country, assuming Singapore, the person is a resident of that country also. In that case, this test applies. Resident in the country of permanent home. So then the first test is where the permanent home is available to him. Assuming he has permanent home in both the country, then the second test is where is the center of vital interest. It means where is the economic or personal and economic relationship is closer. Assuming the person who is resident of Singapore, but his family is residing in India, whenever he gets leave, he came to India, and he has decided whenever I'll conclude here, I'll go back to India. It means here he has his economic and personal relationship is in India. In that case, we say no, that person is a resident of India. But assuming that person has a central of vital interest in both the countries, then of course that this test will not satisfy. Then will come to habitual abode, and then the nationality. So this is the way we need to test the person with resident of India. Assuming this test is not satisfied in any case, then we only go to the competent authority for the purpose of decision that decide my residency. Otherwise, generally, out of this, the person is decided where is he is a resident, and based on this, the other then only the treaty benefits will apply, and then whether the credit he will get or not. So one can ask the question: unless I am the resident, I'm tested that I am resident of that country, how I can apply the treaty to test whether I am a resident of that country or not? So for the purpose of applying the test of residency, the residents, you need not to be resident of that country. If you are resident of that country, then the application, this test is not required. So to decide whether you're resident or not, this test is important. I think I clarified my view. So tiebreaker rule in case of other than individual, because in case of individual we discussed this watered down approach, but in other than individual, the place of management is the key. If the place of effective management is in particular country, then he is a resident of that country, and so it is basically tested on this way, that where is the place of effective management. While using the term place of effective management, one can say, what if I have place of effective management in 2 countries? So if your place of effective management in 2 countries, then understand that is your place of management and not place of effective management. So place of effective management can be only in one country, and that too needs to be tested as per the provisions given. And in case of domestic law also, in explanation that is given what is the meaning of place of effective management. So substance test is there, activity test is there. So based on this, yes, you are falling under that category, then your place of effective management is in India. And otherwise, then you need to go to the competent authority to decide where I am resident. So I think I can hand over to you. Yes, ma'am.
Sure. Thanks, Sachin. With this, we'll move to permanent establishment, P. The notion of P is one of the most important issues in the treaty-based international fiscal law, perhaps the single most important one. And all modern tax treaties, they use P as the main instrument to establish the taxing jurisdiction over a non-resident's business activity in the other state. So the existence of a P is the decisive condition for taxation of income from business. So this is the reason, why P. Historically, states have tried to tax the income on the basis of nexus of income with the state. I am a foreign company. So let's say I am working with India or I am working in India. What is my presence in India? What is the nexus of income from India? Is it so attached to India that I am practically doing my business in the country, and therefore, because of the presence of P, I, as a foreign company, need to pay my fair share of taxes to the Indian government. This is the basic concept. So the tussle between the countries resulted in double taxation of the taxpayer. This is the same what we had discussed in earlier slides. Consequently, the concept of P was introduced. P determines the right of a contracting state to tax the profits of the enterprise of another contracting state, and the concept marks a dividing line for businesses between merely trading with a country or trading in that country. The rule is designated to show business activities will not be taxed until and unless they have created significant economic bonds between the enterprise and that state. So all bullets, what we have discussed, P is resultant of double taxation. That is why the P is there to solve that issue. Now, there are different types of Ps. The treaties specify in what cases it will be considered that PE of a foreign enterprise is there in India. If there is a PE of the foreign enterprise in India, then only the business income of the foreign enterprise will be taxed in India. In the absence of the PE, the foreign enterprise doesn't get taxed. I'll take this by way of an example also after completing the next slide. Next slide, please. Yeah. So business profits which are earned by a foreign enterprise, it shall be taxable in India only if the enterprise carries on business through a PE. Article 5 defines the term PE. It lays down the conditions, what constitutes a PE, and Article 7 talks about limiting the taxing capacity of the state only to the profits that are attributable to the PE. The comparable term to the P under domestic tax law is business connection. But again, business connection is a very, very wide term. PE is little a narrower term. So as I mentioned, we'll discuss this by way of an example. Let's say there is a foreign company and it supplies some hardware or some equipment to the Indian company. The question arises whether the supply of the equipment by a non-resident to the Indian resident is taxable. The first thought, the answer which comes is no. Even under the domestic tax law, this should not be taxable because the title of the goods is getting transferred outside India. And then the second argument is that this should not be taxable because the foreign entity is not having a permanent establishment in India. It is only when the foreign entity will have some sort of presence in India, then it can be construed that a PE is there in India. And if the PE is there in India, then the profits which are attributable to the PE can be taxed in India and nothing more than that. Moving to the next slide. Yeah. So this is a diagrammatic representation for an enterprise carrying on business activity in India. The business profits taxable if there is a P. So you check Article 5 first, whether there is a P in India. If the answer is yes, then the profit needs to be computed in the specified way as mentioned in Article 7 on the right side. If there is no PE, then the business profits which are earned by the foreign entity is not taxable. So the PE is to determine the right of India to tax the profits of a foreign enterprise. Again, income from certain other sources like royalty, FTS, interest, they are taxed on gross basis unless effectively connected with the P. So just from a clarity perspective, again, if there are certain special sources of income like royalty, FTS, we test them it's to be taxed on a gross basis, on a source basis, till the time they are effectively connected with the PE. If these incomes are connected with the PE, then they will be taxed in accordance with Article 5 and Article 7. And other than these royalty, FTS, assumingly they are not connected with the PE, then we see other business profits. The example which I gave, that supply of equipment for overseas, it will be taxed in India only if it is having a permanent establishment in India. So there's a question from Rohit on the PE, because I'm talking this, so I'll deal this question. The articles referred in PPT are from which treaty? So it's not a specific treaty. They are generic articles quoted. Some of the MFN clauses we talked about were specific to the Swiss and the Netherlands treaty. But now when we talk about permanent establishment, it's the general way the articles are framed in a treaty. You will find in the majority of treaties, they are framed in this manner, which will talk about fixed place P, service P, agency P, construction P, etc. Next slide, please. Yeah. So this is different types of P, what I just discussed. We will start with the fixed place P, then move on to agency P, service P, etc. Next slide. Yeah, so fixed place P will be talking about in the ensuing slides that if the foreign company has an office space in India, let's say there is a permanent office of the foreign company in India, how that results in a fixed place P, whereas the fixed place P may not be construed if the activities undertaken by a non-resident are just of preparatory and auxiliary nature. There are other tests to be satisfied. We will discuss in detail about the permanence disposal test. There's a concept of construction P, that if the building, construction project, installation project is carried out in India exceeding the threshold limit, it leads to a P in India. Next slide. Again, there's a concept of service P in some of the treaties. This is a concept which is there based on UN Model Convention. OECD Model Convention doesn't have this service P. In the Indian treaties, some of the treaties will have this service P clause, whereas in some of the treaties we find service P clause is not there. Service P we'll discuss in detail in the slides, but the main crux is that if the foreign entity is furnishing the services through its employees in India, then a service P of the foreign entity will be constituted if the threshold of the people staying in India exceeds a particular number of days. Then there is a concept of agency P, that if there is an agent in India, the foreign entity's agent is concluding the contracts, it will again lead to P. So let's discuss this one by one in the coming slides. Yeah, okay. So this is a concept, fixed place P. PE is defined as a fixed place of business through which the business of the enterprise is wholly or partly carried on. I repeat, because there are different conditions in this one line written, that PE is a fixed place of business. So the first important thing is fixed place of business. Then it is through which the business of the enterprise is carried on. So if there is no business carried on, it doesn't result in a P. Let's say the back office service. If there is actual business carried on, it results in a P. So as per international tax commentaries and the principles which have been enunciated by the Indian judiciary, the three conditions that needs to be cumulatively satisfied for a foreign company to constitute PE in India are as below. First is place of business or disposal test. What this means is that the foreign company has a place of business in India which is at its disposal. At its disposal means that the foreign company should have the right to use the said place and have control thereupon. So this is one of the first basic important conditions. Place of business disposal test. There has to be a place of business in India which is at the disposal of the foreign enterprise. And then is the permanence test. That said place of business should be fixed. That is, there should be some degree of permanence in establishing of that place of business. The third condition is business activity test. That is, foreign company should have carried out its business activities through such place of business. If there are no activities carried out through the place of business, then there is nothing that is earned from India and nothing is taxable to the PE, even if it is there. So these three tests are very, very important. And fixed place of business doesn't get construed in case the activities are only preparatory or auxiliary in nature. Now, generally, question comes, how many days the presence of the foreign entity has to be in India to constitute a fixed place P? We have seen in OECD commentary that generally the concept is 180 days or a 6 months period, but it is relevant to mention that basis certain recent judicial precedents like Formula 1, 6 months is no sacrosanct condition. It says that if the foreign enterprise is present in India, let's say only for 10 days, but that entire activity could be completed only in 10 days itself, then it will lead to a fixed place P. Then one cannot argue that no, it's a 6 months period. I was present here only for 10 days. Then how a P is constituted? No, because the activity itself could have been completed in 10 days. And for that entire 10 days, the foreign entity was present in India. It could lead to a P. The only conditions, the three conditions of meeting this text of P needs to be cumulatively satisfied before advising the clients, like whether you have a fixed place in India or not. Then it's important to see what is the activity the foreign company is carrying on in India. Is it a revenue generating activity? It is carrying on the business activity. Is it meeting the threshold test? Is the place through which the business is carried on, let's see the Indian subsidiary premises. If it is at the disposal of the foreign enterprise and meeting all the conditions, it can result in a P. But if the conditions are not satisfied and simply there is an Indian subsidiary of the foreign company, simpliciter presence of an Indian subsidiary will not result in a fixed place P. We can move to the next slide. Yeah. So now this is a concept of the agency P. We have seen these days practically a lot of litigation comes on what is this agency P. I gave an example a few minutes back, like let's say a foreign company is supplying the equipments. It should not be taxed in India. But practically we have seen in many cases, the tax authorities try to allege that if the Indian company, let's say Indian subsidiary or an Indian company, it is acting as an agent of the foreign company, and it is, let's say, concluding the contracts of the foreign company, it may lead to a constitution of a PE, and then whatever the profits are allocable, attributable to that PE, it can be taxed. So I've just quoted the example first. It may be easy. Now I will discuss the provisions of what the agency PE provides. See, the first condition is agency test. Whether the Indian person who is said that you are an agent of a foreign entity, whether the person is an agent or the person is not an agent. So normally we see in normal parlance, as we interpret how the agency works is whether the agent has the authority to bind the foreign enterprise. If it has, the person will be construed as an agent. If the Indian entity is not an agent of the foreign entity and it is doing the activities on principal to principal basis, then there is no agency concept. Then it is important to test the dependency test. See, majority of the treaties say that if the person is an agent of the foreign entity, but the person is an independent agent, that is, as an independent agent, I'm not acting only for the non-resident. I'm acting in my ordinary course of business and I'm representing, let's say, 10 other companies. So if the person is an independent agent, that will not lead to a dependent agent P. Again, in majority of the treaties, it is said that if the independent agent is representing, let's say, only one of the foreign entities, let's say I am an Indian subsidiary, I am representing only my foreign company in India. But if my transactions with the foreign company are at an arm's length price, then again, the person will be construed as an independent agent under the treaty, depending on the language of the treaty. And this is the case in majority of the treaties, that either the person is independent, acting in ordinary course of business, or if the person for any reason is construed that it is not acting in the ordinary course, it is representing just one principal, its foreign parent company. But if the transactions between them are remunerated at an arm's length basis, then again the person is independent agent and no dependent agent P. Coming back to the cumulatively satisfied condition, we test agencies. Are you an agent? Okay, let's say yes. Okay, next condition, are you an independent agent? Yes, no P. Next is no, I'm not an independent agent, I am a dependent agent. Whether that automatically results in a P, the answer is no. Even if the person is a dependent agent, to satisfy the P test, there are other conditions to be satisfied, like habitual conclusion of contracts, or habitually securing the orders, or maintaining the stock of goods to come to the conclusion that there is a P of the foreign enterprise in India. Now, I will also discuss in the dependency test, how do you say that, let's say my Indian subsidiary is dependent on me, or the Indian agent is dependent on the non-resident. The dependency is tested in terms of legal and economic independence. Legal independence refers to the term that there is a substantial degree of control which is exercised by the foreign company over the agent. That is, the agent is not independent to take actions, or the way he wants to do the work, that is not done, but he is subject to detailed instructions and controls from the foreign company how to do the work. If this is the case, then it will lead to legal dependence of the Indian agent on the foreign entity. Now, economic independence is that how an agent's business relations with the enterprise are shaped in economic respects. To put it in simple language, whether we can say that an agent can stand on his own, he does not have to look to the principal for its economic viability. Let's say the Indian agent, he says, my total revenue is 100. You are making me an agent of the foreign company, but from that foreign company, I'm just earning 20% of my revenues. I am 80%, I'm earning revenues on my own account. So I am an economically independent person. Then again, it is, I am economically bearing the risk for the activities which I am doing. So I am not a dependent agent legally and economically. Okay. Now, assuming, okay, let's say the dependence test, the legal and economic dependence test also gets satisfied. Now, again, we have to test for a PE. Once the dependency test is satisfied, whether the agent has and habitually exercise in India an authority to conclude contracts on behalf of the foreign entity. What it means is, one, there should be an authority to conclude contracts. And then second, it has to be exercised habitually, regularly. It cannot be a one-off transaction. So concluding contract means negotiating the essential elements of the contract. Let's say there is an Indian subsidiary. It negotiates the contracts for the foreign entity throughout, taking all the decisions. But only the signing of the contract happens in the foreign country. So this will lead to a P exposure, because in essence, the contracts are getting concluded in India. It's only for the signing purpose the contract is getting concluded outside India. Then there are other conditions also. So if these are one or the other conditions, not mutually exclusive, not cumulatively to be satisfied, that one, if the person is exercising an authority to conclude contracts, if the answer is yes, there is a P. If the person is maintaining a stock of goods in India, and from that stock of goods which belongs to the foreign enterprise, the person, the Indian agent, is regularly delivering the goods, then also it constitutes a P. The third condition, which is not mentioned here, but in some of the treaties it's there, securing orders. The person is securing the order for the non-resident company. That is a step prior to conclusion of contracts, securing the contracts. Then again, it will lead to formation of a dependent agent P. There are certain questions. I'll take that. And then I'll discuss again in the BEPS world. There are more, provisions relating to P are more stringent. So the first question is, can you please clarify agency agents context in case of foreign shipping companies? There are many Indian companies representing as pure agent of more than one foreign shipping companies. Okay. Kavita, I'll take your question. This is very specific to foreign shipping. I'll take this maybe off the line, but just to lay the context here of the agent, the concept is you have to see whether the Indian agent has the authority to bind the foreign person. If the answer is yes, that is, see, you represent that I am an agent of FCO. You take the goods from me. So in case I'm able to sell the goods, the foreign company will honor it. So by way of, it could be implied, it could be expressed that foreign company is allowing the agent to represent itself. So it will lead to an agency. So there are certain questions coming on poem and P. Sachin, should I complete this just agency concept and then we can take the questions?
Yeah, I
on
think that
poem?
will be better. Let's conclude your agency P, then we'll take all the questions.
Sure, sure. Okay, so this is the thanks Avneet. So this is the concept of P, agency P, and believe me, practically it is being used a lot. Wherein, day in, day out, there are, allegations from the, that the Indian subsidiary, why it not be construed as a dependent agent P? Because it is undertaking certain activities. It is doing much more activities than what it is doing. In those cases where there is such an allegation, it is very important to understand the concept of P, whether I'm an agent. So to see, what are the agreements? what in a sense on the ground practically how the things are done, how the Indian entity, what is the role of the Indian entity in undertaking the functions, whether it's exceeding its function or it is doing a limited function, whether I am an agent, if I satisfy as an agent, whether I can still say I am an independent agent and no taxability. Even if I'm not an independent agent, I am a dependent agent. Please test each and every condition. Can I be said I'm habitually concluding the contracts? Can I be said I am maintaining a goods, stock of goods from which I am delivering? Can I be said I'm securing orders? If none of the condition gets satisfied simply because I am an agent, that does not lead to constitution of an agency P. Just completing the last leg of agency P, what we talked about in the BEPS world, which is more stringent in the sense it says, even if you're not concluding, if there are certain activities of the Indian person, Indian agent, which leads to conclusion of certain contracts. So it says actually you're not concluding, but your activities are leading to conclusion of contracts, then also a P can be formed. So some examples how it could be leading to conclusion of contracts is, let's say there are certain standard contracts to be signed by a non-resident. The Indian company, let's say it is doing majority of the activities. It is going, explaining the products, it is soliciting the customers. So majority things are done by the Indian. It is negotiating the terms of the contract, and the foreign company is just taking the final decision, okay, sign the contract. The principal activities which are done by the Indian entities has already been completed, which in a sense leads to conclusion of the contract. Therefore, in the BEPS world, it is made more stringent in the sense if the activities lead to conclusion of contracts, not actual conclusion a step prior, it will be construed as if there is a dependent agent, P of the foreign entity in India. I'll take a pause here, hand over to Sachin for some of the questions on POEM and P. This will give some time to absorb the P concepts, and then we'll move to the service P1.
So thank you, Geetika. In the last line, what you have mentioned, that is for the purpose of place principal role. So if you remember in the Finance Act 2018, so India has amended the act and says if the agent is playing the principal role or playing the role of principal role in conclusion of such contract. So whether or not he has concluded the contract, if he has plays the principal role in conclusion of such contract, then also it can be said that yes, business connection is there. So that was the amendment in respect of this line, and then as we discussed. So coming to the queries which we are talking about. So if the company, so Rohit is asking if the company has satisfied POEM, is it obvious that it has a P2 in India? So Rohit ji, basically these are two different concepts. So by virtue of place of effective management, referring to section 6 subsection 3, we try to make the foreign entity as a resident of India, and if it become a resident of India, then all the global income would be taxable in India. But because you know that in case of company, the place, the resident and not ordinary resident concept is not there. So if there is resident or non-resident, if it is a resident, if it becomes resident by virtue of section 6 subsection 3, that is place of effective management, then it becomes resident of India. The other is the P. The P means the entity is non-resident, it will remain non-resident. The only thing is by virtue of their activity or the other things, as Geetika has mentioned, it becomes a permanent establishment in India. If it is so, then the taxability would be at different rate. So assuming the entity is providing fees for technical services, FTS. So generally we apply 917, assuming the activity or the nexus is so close that it becomes a permanent establishment in India, then we will not apply the FTS rate, that is 10%, we'll apply the business income rate. So that is the gross, on the gross total income, the 40% rate, so net income, the 40% will apply. So that is the difference between applying the POEM and the P. Okay, Avneet sir has the same query, difference between POEM and P, which is to be considered as POEM. P articles Rohit is asking the article referred to PPT are from which treaty? So basically this concept comes from the MLI, and where it says that the principal purpose test, basically it's a minimum standard. Out of the 3 minimum standard, one is the principal purpose test, and that here you need to satisfy that why you are through this country, and why as we mentioned in the earlier discussion also, that assuming the UK company wants to come to India through Mauritius route, and they have some establishment in Mauritius just for the purpose of showing that they have establishment, or they have registered the company in Mauritius or a paper box company, and they come to India, invested in India through Mauritius, then of course, what is the why through Mauritius and why not directly? So you need to satisfy. If the tax benefit is not there, then you can say that even though I'm not satisfying the PPT clause, but I am not getting any tax benefit. But if you are falling under the PPT clause, if you're not satisfying the PPT clause, then the treaty benefit will not available to you. If a company has satisfied POEM, which will it be obvious that it has a P in India also? So I think we have answered this question. It is practically possible to take FTC. So Ruchi is asking, is it practically possible to take FTC of taxes paid in India under employment contract in Ethiopia, where the employee has been deputed to Ethiopia on a project and tedious compliances are done by India? So I think in your question, you want to say that the Indian company has sent his employee to Ethiopia on deputation or for the activity there, and Indian entity is deducting the tax and depositing in India. So you are asking that whether in Ethiopia, whether he will be able to take the credit or not. Ruchi, Geetika, am I right understanding this question?
Yes.
Is it practically possible to take FTC of taxes paid in India? So as far as concerned to employment contract, let's try to refer section 912, where it says where the service is, where the employment is exercised or the service is rendered. So the in case of salary, the income will be deemed to accrue or rise in the country where the service is rendered. And this is the similar clauses more or less in all the treaty provisions, that where the service is rendered, the employee will be taxed in that country only and not in the other country. Here you are saying that the employer is deducting the tax in India and depositing into the Indian government. So whether he will be able to take the credit of that taxes or not. So for applying treaty benefit, for availing the treaty benefit, it is important to understand that the person is liable to pay tax in both the countries, is liable to pay tax on such particular income in both the countries. Then only you can go into treaty and take the benefit of avoidance of double taxation. Here, the taxes is applicable in one country and not in the other country. So it will be difficult to give the benefit, but generally, practically speaking, while filing in return in India, we take the benefit that we have, the tax has been deducted. But it is important that whether such income on which you are taking the credit, whether that is taxable in the first hand or not. Here you have not mentioned whether the employee is resident or non-resident. So assuming if he's a non-resident, then of course he will file his return in India and he will get the credit in India. But as you mentioned that under the employment contract, whether he would be practically possible him to take the FTC for taxes paid in India under Utopia, that needs to be tested. But what is the provision of law that we explained to you, that needs to be tested on the fact of the case.
Right. And just, Ruchi, supplementing, you've written the employee has been deputed to Ethiopia. So it's important to see, typically whether it's a secondment arrangement. It's very important to see the facts, whether the employee has been seconded, who is the economic employer, who is the legal employer. So all these things will also be very important to see in addition to what Sachin mentioned.
Okay, so Amnit sir is asking POEM foreign entity backed from India or not? PE foreign entity having just an establishment in India. Please clarify. Is it correct? So POEM, we just explained. POEM means the company is a foreign company. It will remain continue as a foreign company, but it will become resident of India. That's why Section 195 says any person responsible for making payment to a non-resident, not being a company or to a foreign company. It means the company will continue as a foreign company. It will not become an Indian company, but it will become resident of India. And in case of P, foreign entity having just an establishment in India, and it may just, as Geetika explained, that what are the conditions where it can be said that yes, it has a permanent establishment in India. If you're satisfying those conditions, then yes, your permanent establishment is in India, and then you will be taxed differently. Vikas is asking, the Indian company has hired employee in India and deputed the foreign, The Indian company has hired employee in India and deputed to foreign country for 3 years. Indian company is continuing to pay the employee for India to its Indian bank account. What will be the TDS provision in India for Indian company? So you are asking, your question is in respect of the TDS provision in respect of such payment of salary. So as, am I right? Geetika, you want to add something?
Yes. He's asking in respect of a TDS provision, and I think the question also revolves around, like, if the person is employed with the Indian company, the person is deputed to the foreign country for 3 years. Then I think again the same concept. It's important to see who is the legal, who is the economic employer. See, the person may be getting salary from Indian company due to administrative convenience reasons, that the person has a bank account in India, the person has a family in India. But again, the reverse what we talk about, when a foreign company seconds person to India and the payment is made. So I think the same logic here. The important thing is, if the Indian company is making TDS, deducting TDS, that will be under 192 if the person is employed with India and the Indian company, let's say, is the legal and the economic owner. But the things will change, if we have to see, like, if the person is in a sense an employee of the foreign company, then why not the foreign company? Then why the Indian company is deducting tax? So one has to see all those typical issues in deputation secondment arrangement. But generally, where the Indian company, assuming it's the legal, it's the employer, well, then it will have to deduct tax. Sachin, is it okay under 192?
Yes, absolutely correct. And one thing in this transaction, since the the Indian company has 3 employees who is deputed outside India, so it needs to be also be tested whether they are carrying the business of Indian entity. If so, then can it be said that Indian entity has a permanent establishment outside India?
Absolutely.
So that also needs to be tested. So in this question, there are so many facets can be considered.
Absolutely. Okay.
I think Sumit is saying good evening, everyone. We'll start. Okay. I think it is.
Okay.
Anything else?
वो ओपनिंग का था सचिन जी.
Okay, sorry. मुझे लगा कंक्लूड कर रहे हो 2 मिनट में.
नहीं अभी तो सर सर वैसे बहुत अच्छा सेशन चल रहा है ऑलरेडी. अगर कोई क्वेरी और रह गई हो तो आई वांट टू कंक्लूड with the queries.
I think it is better to take the queries, Geetika, because slides so we can share.
Right. Sachin, I think queries, to my mind, all queries till time has been answered.
Yes, madam. It is a great thing that till now all queries, all things has been cleared to everyone. Still, any query with the members, you can post in the chat box.
I think Kavita had one query. Maybe it's the time. If we can just scroll to the query of Kavita, or Kavita, if you can repost. There was a query on TRC, tax filing of the return.
Okay. Kavita, if you are there, you can repost your query.
I think this one is a comment. Ma'am, please clear my point of confusion. Why foreign entity will file return in India?
Yes.
where they say that they are tax resident of another country in their no P declaration and through
True.
TRC itself.
Yeah, I'll take this question.
Yes, please.
So, Kavita, if I understand your question is, there is a non-resident company. Non-resident company has taken a TRC from the country of its residence, that is, let's say from the US tax authorities. Now, non-resident says, I have no PE. The no PE declaration is given to the Indian person who's making the payment. So your question is, what is the need to file a tax return in India? I'll take an example. See, if the Indian company is making payment to a foreign company, it has no PE, nothing to do with India. The transaction is not at all, let's say, taxable under the domestic tax law itself. Then there is no requirement to file the return. However, if assuming there is a taxability under the domestic tax law, but under the treaty the exemption is claimed, then generally we take a, the position is taken that it's better to file the return, because how will the tax authorities examine that you are not taxable? See, you are saying I'm not taxable under the treaty. So still you may need to file a tax return. The example which we were discussing earlier was in case of fee for technical service. Now, foreign company provides certain services to the Indian company. Let's say $100. Indian company makes the payment to the foreign company, withhold tax at the rate of 10%. There could be 2-3 scenarios in this. Scenario 1, the foreign company says you have wrongly withheld the tax on a source basis. I don't have a P, I have TRC. Now I will file my return and claim this withholding tax as a refund from the Indian tax authority. So this is scenario 1 where the return may be required to be filed. Scenario 2 could be Indian company has deducted the tax at the rate of 10% under the treaty, let's say, and not under the domestic tax law. Under the domestic, the rate was, let's say, 10.4%, whereas under the treaty, the rate is 10%. Then again, the foreign company will have to file a return because the law provides an exemption to a non-resident to file the return in case of FTS only when the tax has been deducted under the domestic tax law provisions, which is 10.4% and not 10%. One may choose not to file a return, but technically it may be better to file the return in such cases, at least when it is FTS and the tax is not deducted under the domestic provisions, or the person wants to claim the refund of the withholding tax deducted. Anything, Sachin, you want to add to this?
I think you fairly covered everything.
I hope, Kavita, that answers the question.
I think no other questions are there.
So should we continue with the slides?
Yeah, please.
Okay. The last concept of the P which we'll be talking today is the service P. This is basically furnishing of services other than fee for included service. Other than fee for included service means some of the treaties it will be fee for included service, some of the treaties it will be called fee for technical service. If there is a service which is provided by the non-resident, if it qualifies out fee for technical service, then service P is not to be seen, then it is outside the ambit of FTS. But if it does not satisfy the test of FTS and there is a furnishing of services by the non-resident within India, the important term is within India. If the non-resident is providing the services from outside India, then there is no P. There has to be a presence in India of the foreign enterprise through the employees or other personnel to trigger a service P. So the conditions are services are furnished in India, services rendered are other than royalty and fee for included or fee for technical services. Services are rendered through employees or other personnel of the foreign entity. And if the period of stay in India exceeds a threshold, it leads to P. So I've just written these words. I think we have written from US treaty, which says 90 days in any 12 month. 1 day is US treaty or 30 days in different treaties. Depending on the language of the treaty, one has to see how many days the person has stayed in India. and practical examples while conducting the audit proceedings of foreign company. This is a general question which is always asked, that has the personnel of the foreign entity visited India? What is the purpose of the stay? What is the duration of the stay? So these questions practically come. It is important to see from the perspective of service fee. If the threshold exceeds, if the stay exceeds the threshold, it could lead to a service fee exposure. Next slide. Services rendered from foreign entity without presence in India. We discussed this example. There is a provision of software implementation services through emails and conference calls. No employee of the foreign company has ever visited India during the year under consideration. So the question is, and again, a third condition, let's assume it doesn't qualify as fee for included service under Article 12 of Indo-US. The question is whether it results in a fee. The answer is no, because no person has visited India. And this is settled by the various judgments, I think, E-Fund Supreme Court. This was settled that furnishing of services within India has to be there. Another question could be there, what is the interplay between service fee and FTS? These are mutually exclusive. Income can be taxed either as FTS or under P. So before examining whether the requirements of service fee are met, one has to test the requirements of Article 12 or 13, as the case may be, royalty or FTS. If it is royalty FTS, fee for included services, no service fee. If not, days exceeds threshold, then service fee trigger could be there. Next slide, please. The third question normally comes is, if the services are rendered by the foreign company through its employees, then it's clear that service fee will be there. But the treaty also talks about services rendered through employees or other personnel. Then what does this term other personnel means? There are various rulings by the ITET on this, wherein it has been held that the meaning seen in relation to the word employees by applying the principle of adjustum generis. Therefore, other personnel will cover those individuals who are under the supervision, direction, or control of the foreign enterprise. So whenever in the practical cases, it's not an employee of the foreign company who has visited India, but there is any other personnel who has come to India, who's hired by the foreign entity to test whether it will result in service fee. It's important to see whether that foreign personnel is under the supervision control of the foreign enterprise. If yes, then service fee triggers. If no, service fee ought not trigger in such cases. There is a question, I think, since software subscription is not royalty as per DT and read with Supreme Court, the tax rate will be nil. What is the tax rate as per Income Tax Act? What will be the usual tax rate? So Saundarya, you are right that, basis the Supreme Court decision in engineering analysis, if the facts match the case of the Supreme Court, yes, software supply of software is not taxable as royalty. In case it is not taxable, the question of rate will not come. It is zero. You have also rightly pointed out. What will be the rate as per income tax? See, normally there is no point going to the income tax, because one may say the provisions of income tax are too wide, they are too broad, and therefore it could qualify as taxable under the Act. If yes, the tax rate would be 10% plus applicable surcharge cess. But normally what we take is treaty or domestic act, whichever is beneficial. So you'll have to move to the tax treaty considering the beneficial provisions. No withholding. Section 195, which Sachin also discussed in the beginning. It's like paying any income, which is chargeable to tax, then the withholding needs to be done. If the payment is not chargeable to tax, then there is no question of withholding the tax. The rate will be nil as per treaty provisions. And we normally see, normally for software matters, I've seen practically we go in for treaty being the same, more beneficial as compared to the domestic tax law. Because on the domestic tax law, again, there's a lot of controversy by the amendment of the Finance Act 2012. What about software? So generally the discussion is as per the treaties when it is clear that it is exempt, specifically with the Supreme Court judgment of engineering analysis coming in. Okay, with this, I think we are almost done with the P aspect. We will be discussing few other things: business profits, dividends, and trust royalty, FTS, capital gains. Sachin, if we can move to the next slide. So on the business profit, it merely, generally talks about like the profits which are attributable to the P, which will be taxed. And what are the attribution principles? All that we will be taking in day 3 on the transfer pricing session.
Right. So before this, Mr. Ajit has raised this query. 15 CB also not required in this case. So in case of 15 CB, so if you see, it is applicable when the sum is chargeable to tax or you are taking any treaty benefit, then only the 15 CB is required, otherwise not. So of course, treaty benefit will come into picture only when the sum is chargeable to tax. If it is not chargeable to tax, you can, I think, opt for part D of 15C and then it's okay. So 15 CB is not required. Yes, we're right. Okay, one more question. Mr. Sunil has raised one question. Indian individual earned salary from April to July in a financial year in employment in Belgium, then came back to India and remained in India from August to March. Okay, if salary earned in Belgium is to be included in ITR or not to be included, Belgium tax has been deducted as per the calendar year. So the one school of thought is, yes, since the fact is not clear whether he is resident or non-resident, so if assuming he's a resident, then of course his global income would be taxable in India. So income accrue or rise to him outside India is also taxable in India. So in that case, yes, his total income, that income earned in Belgium will also be considered here for the purpose of total income. And yes, the taxes what he has paid in Belgium, that he can take the credit in India. So Mr. Vinesh is asking, when no TDS is liable to be liable to TDS, then why banks are asking and compelling to provide 15 CA and CB? Okay.
Good question, but
This is a very
banks are
practical
asking
question,
continuously.
and as you rightly raised that bankers are not understanding that when 15 CB is required and when not required. They use this term jointly, 15 C and CB. So they say 15 C CB, bring for 15 C CB, and then so I think tomorrow we have a separate session on this.
Separate session for detailed discussion.
So learned speaker tomorrow they'll cover. Yes, Geetika.
Okay. So this we have almost covered. Characterization of income means classifying the income earned by the assessee under the relevant head of income to determine the tax liability. What we discussed in the earlier slides, the substantive provisions, under what nature it falls. So we can move, Sachin, to the next slide.
Okay.
This also we discussed. Business profits, what are attributable to the P will be taxed. And again, on the detail of attribution on the transfer pricing session, again, we have day 3 session on this transfer pricing thing.
Right.
We can move ahead. This is again the diagrammatic presentation. Foreign entity, profits covered by other articles. Taxable will be as per those articles, dividend interest. In case they are not covered by specific articles, P in India, no, then no taxability. If P is there, then taxability is there and attributable to profits will be taxable. Next slide. Yeah, Sachin, over to you.
Okay, thank you. So I think we've discussed the basic concept so far. So now only the thing is whether the particular income, how to tax and how to understand in context of treaty. So before going to treaty, we need to understand for every transaction that what the domestic law says. So while referring to dividend, of course, 914 would be applicable. And in that case, it says the dividend paid by the Indian company to anyone, it is taxable in India. So if it means if the Indian company is paying dividend, it is taxable in India. But the treaty says dividend paid by a company which is resident of a contracting state, it means a resident of India to a resident of another contracting state, it will be taxed in other contracting state. So if you see, generally for our understanding, dividend, interest, royalty, FTS, dividend, interest, and royalty. As far as concerned to these three transactions, it generally says that these are a passive income, and for this, no need to put a lot of efforts to get earning of this. So dividend, interest, and royalty. So generally, if you can see that in case of OECD model convention, it says that where the resident, the person who is receiving the residency of that the country, that will it will be taxed in that country and not in the other contracting state. It means that DT says dividend paid by a contracting state which is resident of a contracting state. Dividend paid by a company which is resident of a contracting state to the resident of other contracting state may be taxed in that other state. It means where the person who is receiving is resident. However, of course, it is taxable in the country where it is the company which is declaring the dividend is that. There are few conditions. Of course, the beneficial ownership will come into picture, and in the same article, it says that if it is connected from the business, then it will fall under Article 7 and not under the dividend treaty. So, dividend income from shares, rights being not debt claimed. The dividend from shareholding effectively connected with a P, then it will go to Article 7, as you mentioned. Dividend paid to beneficial owner, then it will come to as shares taxed on the gross basis in source country. So, if you are beneficial owner, then it will fall under it will tax under the source country. Otherwise, it will tax under the residency of the person, resident country, where the person is resident, the receiver is resident. However, in domestic law says if the Indian company is declaring the dividend, it will be taxed in India. So, of course, in this case, the DTA provision will apply. Interest. If you see in case of interest, applying again 915, that how the interest should be taxable, then you say if the government of India is paying, then it is taxable in India in any case. If the payer is resident and if the payer is non-resident, then only it will be the taxability is depending upon the utilization of that fund. Similarly, if you see the interest, the Article 11 in case of OECD model convention, then it says that it will be taxed in the country where the resident or the receiver person is there. But subsequently, it says that the beneficial ownership, of course, it will apply. And if it is connected to the business, then the Article 7, it will go to Article 7. So referring to Article 10, 11, 12 to some extent, and where royalty FTS is there. So more or less the provisions are similar. Coming to royalty, I think we have discussed a lot of things about royalty so far, and of course, based on this, the taxability would be depend. Before going to this, just try to refer 916, read with explanation, and then go to the treaty application. And before this, since the judgment is already there, so it will. I think it will not be applicable on most of the transactions. So needs to be tested, and of course, there is no yes or no law in this. You need to test based on the fact of your case. Similarly, FTS, I think, do we need to discuss every slide because we have already covered so many things?
Yeah, I think we have covered majorly on this. In fact, there are certain questions which we can take on the slide.
I think that will be better because we are running short of time, and we got the instruction from Sumit also.
Yeah, so we can take the questions.
I think that will be better.
Sure. Maybe the first question is from Mr. Sunil Gupta. What about if agent satisfying all the tests of dependent agent but earning revenue only 20% from FCO? So I would like to put it like where the agent is earning only 20% of the revenue from foreign company, and it is earning 80% from, let's say, other unrelated parties of the foreign FCO, then it can be said that the agent is economically dependent. So the independent, economically independent. So one of the conditions of dependent agent P was that the agent needs to be legally and economically independent. But in this case, the person can be said that the person is economically independent, hence dependency not satisfied, hence no P. But yes, documentation is very important. And if I'm correct, I think there is a judgment of NetApp of the Delhi Tribunal, which discusses this concept.
Yes.
Okay, the second question is, please clarify data processing, data processing services received from US, value 80 lakhs as per income tax, tax at the rate of 10.4. Please guide any exemption in DTA for such. Okay. See, under the Indo-US treaty and the slide which was there on FTS, maybe we'll discuss relevant to this. See, what domestic tax law is very, very wide on technical service. It says any managerial consultancy services will get qualified as FTS. The treaty, like US, it says there is a concept of make available. One, there is a rendering of a technical service, first of all, by the foreign entity to the Indian entity. Then that foreign entity makes available the service to the Indian entity. Make available means that you teach the Indian person how to do the service, so that from the next time the service is required, the Indian entity will not have to go back to the foreign entity. It has made available the service to the Indian entity. Then only if such a case is there, make available test is satisfied, then only it will be taxable under the DTA, otherwise not. So under the treaties like UK, US, there is a benefit provided as compared to the domestic tax law provisions, which says till the time the service is made available to the foreign enterprise, it will not get taxed. So made available is, you have given the service to me, I can apply the technology. Let's take an example as chartered accountants. I am rendering a professional service to my client. So I have given the deliverable to the client. I have done rendered a managerial or a professional service, but I have not taught the other person how to do that deliverable. So the client wants an opinion from me, I'll give, but the client tomorrow will not be able to himself draft that opinion and to go give it to someone else, have to come back to me. Whereas in a scenario, I teach the client that, okay, this is to be done like this, XYZ. Tomorrow somebody comes to you, you can give that opinion. Then it is called make available. So the answer to the questions is yes, Indo-US treaty provides for a beneficial provision till the time service is made available. One can say that it is not taxable and hence no TDS. The next question from Deepika is, if an individual takes a consultancy service from a foreign company, which is taxable in India and as per DTA as well, does that person has to apply for TAN to deduct tax? So Deepika, in this case, the Indian company will have to deduct tax while making to the foreign company. So like foreign company has rendered the service for $100, the Indian company will deduct tax. So TAN will be obtained by the Indian person because it is deducting that TDS while making payment to a foreign company. And in case the foreign company has a PAN, it will appear in its form 26AS that this is the TDS which has been deducted by the Indian person and I'm eligible for credit of the same.
So here she wants to ask that if the receiver is individual. So just to clarify that even though the receiver is individual, the TDS provision will apply because section 195 says any person responsible for making payment to a non-resident. So individual is also a person who is making payment to a non-resident. One can raise a doubt that if the individual does not have any business, then what? So, or he does not have any turnover from the business. So that is applicable in section 194 series, where in few cases it is mentioned that in case of individual HUF, the person has income from the turnover should be exceeding the certain level. But here, no such type of provision is there. So even in case the individual is making payment to a non-resident, that TDS should be applicable. And yes, the TAN is required to be obtained. Just to add Geetika's view.
Yeah, sure. Okay, I think one of the last questions on the screen is, no, there are more questions coming up. Okay. So subscription for software is royalty or not? It is for right to use and not a buying act. Avneet has raised this question. So to answer this, I would say in the software industry, normally we use the words licensing and not buy, sell. So always, the controversy had been it's a licensing. As you mentioned, it's not a buying act, and you are making a payment for right to use. But to my mind, the answer is the payment is made for a right to use a copyrighted article and not copyright. There is a distinction. See, if you are making a payment to use a copyright, then it's royalty. But you are making a payment to use a copyrighted article. Simply, I buy a book. I'm not commercially exploiting. I'm reading that book. I'm making a payment. I've bought the book. So simply software, it's for a copyrighted article as held by the Supreme Court in engineering analysis, and hence should not be taxable as royalty for the software payments.
Okay, coming to the next.
Yeah.
Vikas has raised, please explain taxability of ocean freight between two countries other than India, paid by Indian forwarding agent to foreign entity. I think in case of ocean freight, there is circular. And in that case, it says that the taxability is to be, I'm not sure that whether it is taxable, how it is to be taxable in India, because if it is running between two different countries, taxability of ocean freight between two countries other than India, then how the Indian and only the Indian forwarding agent, the paid by Indian forwarding agent. So payment, can it be said that a payment is making from India? So it's all because it's all depend upon the income accruing or arising. So income receiving and not the payment receiving. I don't think that it will be taxed in India. So what is your view, Geetika, in this?
Yeah, maybe Sachin, specifically, I think for ocean shipping, one needs to see those specific circulars which are there.
Okay.
Right, because I'm sure that there is circular in this regard.
Yes, there are specific circulars which is very typical to this taxability. So maybe one need to see that.
Okay.
Okay, there is another question by Manish. The litigation of income tax refund as business income or interest income under Article 11 subject matter of litigation. Recently, Delhi ITET held under India US since not effectively Article 11. Okay, Manish, you are right on this income tax refund. I think it's now more or less, settled litigation. Like this is to be construed as interest under Article 11 of the treaty. Practically, we have seen when there is a refund from the income tax authority, in case of foreign companies, they do deduct TDS at the rate of 42%. That is the MMR which is applied to a foreign company. But then what is done in those cases is while filing the tax return, we say, it's an income which is taxable as interest at under Article 11 at the rate of 10%. And the balance TDS needs to be claimed as a refund, and practically it sails through. We have seen in these cases.
Right.
So sir, last query ले लेते हैं जीत कुमार जी की.
Yes, if someone has taken TAN just to deduct TDS one time, how he has to comply with TAN compliances, that is filing of return.
See, practically it could be at least for the transaction wherein the person has deducted tax in that quarter, at least the TAN compliances be made. And from a practical perspective, I think it's just a one-time transaction. then compliances be made for that quarter or for that year, but not forever. Because see, either a person can surrender the TAN if the person doesn't think that there are going to be more transactions from India.
Yes, the PAN has to be surrendered.
Yeah.
Okay, I think we have covered, and there are few
Definitely,
slides which are
definitely.
still pending. We will
It's
share
a
the
long
slide.
marathon session, and Geetika ji has done wonderful efforts to address all the queries from the participant. And Sachin ji is also, as usual, great speaker. Thanks by Abneet ji in many modes. So definitely we will meet again tomorrow by two new speakers. And thank you, madam, for your wonderful session. Asha ji is here, so I request Asha
Thank you,
ji
sir.
to share vote of thanks. Thank you, madam. Asha ji, please conclude by your vote of thanks.
Unmute yourself.
She can do. She can
Yes,
do.
yes.
Yes.
Thank you so much ji, for giving this opportunity to thanks our today's so learned speaker. And I just heard कि इतना मतलब बहुत डिटेल में है, and participants को भी I would like to congratulate. बहुत अच्छी टेक्निकल क्वेरीज उन्होंने पूछी हैं. I guess जो स्पीकर्स इसको जरूर I think agree करेंगे.
Definitely, yes.
बहुत वेग
Definitely.
क्वेरीज आती है, बट बहुत अच्छी क्वेरीज पूछी हैं और इतना अच्छे से टेक्निकली आप लोगों ने समझाया है. थैंक यू सो मच गीतिका मैम, आपने टाइम निकाला और इतने अच्छे से सेशन को लिया. एंड थैंक यू सचिन सर फॉर गिविंग योर प्रेशियस टाइम. एंड थैंक यू ईच वन ऑफ यू, फुल 3 hours तक लगे रहे. एंड बहुत अच्छे से सेशन हुआ है. एंड वी होप कि हमारा कल जो आने वाले और हमारे दिन है इसमें इंटरनेशनल टैक्सेशन के, वो भी इसी
All
तरह
three
से
sections are important. आशा कल
Yes.
15 रेमिटेंस है, परसों भी टीपी स्पीकर से जब बात हो रही थी तो दे सेड कि 3 घंटे में भी कैसे कवर करेंगे. तो ऐसे ही आज हुआ कि मुझे लगा कि लंबा सेशन है, बट 3 घंटे में कैसे कवर करेंगे वही चीज रही.
all the topics are very relevant और प्रैक्टिकली बहुत ज्यादा ये आता है यूज में, क्योंकि आज की डेट में हम देख रहे हैं कि एक छोटा सा भी हमारा अगर कोई क्लाइंट है तो पता लगता है वो किसी आउटसाइड इंडिया के पर्सन से डील कर रहा है और फिर वो ऐसी चीज पूछ लेता है, लगता है यार ये भी नहीं पता थी क्या हमें. मतलब बहुत जरूरी हो गया ये हमारे लिए जानना इंटरनेशनल टैक्सेशन. तो थैंक यू सो मच. कल हम लोग 4 बजे से again 4 o'clock or 5 o'clock.
5 o'clock tomorrow, and we will share the presentation and recording to everyone.
Thank you so much ji. Thanks Asha ji, and thanks all the participants for the wonderful questions, and thanks to the co-trainer Sachin. Thank you everyone.
Thank you.
Thank you everyone.